Meeting to order. Judy, roll call.
Ms. Schotmeyer?
Here.
Ms. Cavness?
Here.
Mr. Sackowitz? Absent. Supervisor Drudy?
Here.
Mr. Stevens?
Here.
Mr. Walker? Absent. Mr. Knudsen?
Here.
Ms. Harris?
Here.
Mr. Shoemaker? And Mr. Goodman?
Here. Okay, let's all rise for the pledge of allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. All right, public comment. I have John Almeida.
I'll wait until the agenda item
Okay.
if necessary.
No problem. Anybody else? Okay. All right, first order of business, any corrections to the minutes of the board meetings held on January 19th, 2016? Okay, no corrections, minutes passed by unanimous consent. Consent agenda, any corrections or objections to the consent agenda?
Move approval, Mr. Chair.
The consent agenda is approved by unanimous consent. Okay, number 3, that one. Okay, discussion and possible action regarding quarterly investment report. Greg.
So, thanks for having us again. So Greg DeForest, Alina Vartanian. Greg Ungerman is at a different meeting today. Periodically, we have to divide and conquer. So we had 2 topics to talk to you about today. One is a review of fourth quarter performance, and then the other is an update on our long-term capital market expectations. Hopefully we'll spend about an hour review on the 2 topics combined, which means I might go through the performance report a little more quickly than we typically do. Okay, so I think you all have the performance report in front of you. And the end of the year was quite a deceiving time period compared to what we've experienced on a year-to-date basis. Behind the second tab on page 9 of our performance report, on the top you'll note that the fourth quarter was a really robust quarter for capital market returns. U.S. stocks were up about 7%, international stocks were up a little under 5%. Bonds lost a little bit of value as interest rates increased. And the U.S. dollar continued to be strong, so foreign currencies depreciated relative to the U.S. dollar, which explains the loss of international fixed income. So the quarter was quite robust for the capital markets. We know that since the end of the quarter, though, we've had a retreat in the risk assets across the board, the stock market. So ballpark numbers, year to date, large cap stocks are down about 10%, small cap stocks are down about 15%, international stocks are down about 15% as well. And bonds have been rallying as yields have fallen in a flight to quality market. So at the end of the quarter, or at the end of the year, I should say, yields were at about 2.25, 10-year Treasury, and then last week they hit about, I think the 1.58% was the low mark that they hit. So we've seen a real flight to quality since the end of this report, since the publishing of this report. On the bottom of this page, on page 9, kind of the big takeaway here is that for the year, returns were essentially flat across most major asset classes. You see that U.S. stocks were up about 1.5%. International stocks were down just about 1%, and bonds were up about 50 basis points. So most returns for the calendar year ended here are going to be real close to 0, plus or minus a couple percentage points across most broad asset classes. So in some regards, it was a disappointing year for capital markets, but it certainly wasn't an awful year, right? It was not, down 20% sort of year like we had in 2008, but I'd say it was a disappointing year. Let's flip ahead to the third tab, asset allocation and performance. And on the top of page 15, here's a chart we always take a look at. And these pie charts show you what your long-term strategic asset allocation is. And that's the target asset allocation in the upper right. So this target asset allocation is the byproduct of an asset liability study that we conduct together, and we come up with the long-term strategic asset allocation expressed in this target. We had our educational session a few weeks ago, and that was the start of the process again for us to go through this asset allocation process to come up and verify your current target asset allocation. So that's one of the big takeaways on this page. What is your long-term strategic asset allocation? 38% US equities, 25% international equities, 9% real estate, and then 28% fixed income. The pie chart on the left shows you what your actual allocation is. So naturally, from quarter to quarter, month to month, there will be variations in assets, and you will differ slightly from your policy target. And you'll see at the end of the year, you had a slight overweight to domestic equity, a slight underweight to international equity, and a slight overweight to domestic real estate. It's notable that real estate has had a very pronounced run over the last few years, so your assets have just grown faster in that asset category than others. International equity is a case in point where assets have not kept up with the US stock market there, which leads to the divergence of your US stock to international stock ratio. On page 16, if you look at the bottom of the page here, you'll note that you started the quarter with $411 million in assets, and you ended the quarter with $426 million in assets. So a pretty meaningful increase, and the increase was due to two things. One, you had net money coming into the portfolio of $1.4 million is what we're measuring here. But more meaningfully, the impact was investment returns of equating to about $13.5 million for the quarter. And if you look up and down, you'll see that your domestic equity portfolio added about $8 million, international portfolio added about $3 million, and real estate added about $1.7 million for the quarter. There was some rebalancing in the quarter, which is evident on this page, and you'll note that you added about $3 million to the Mondrian International Equity portfolio, and so that is bringing you back up closer to that target asset allocation in international equity. Mondrian is a firm that you hired about 4 or 5 years ago, and they're the dividend-focused international equity value manager in your portfolio. On pages 17 and 18, we show cumulative returns ended the end of the year for your managers, your broad asset classes, and the total fund. So let's skip over to the bottom of page 18. And on this chart, you'll note that the total fund for the quarter was up about 3.25 percentage points, a little bit behind your total fund benchmark. So you underperformed by about 17 basis points net of fees in the quarter. For the year, returns were flat, so your total fund return was essentially flat for the quarter. Slightly behind your total fund benchmark, which was up about 20 basis points. So both very close to zero. Longer term numbers are more favorable. For the last 3 years, your compound average return is 7.85%, beating your target. 5 years, you're just under 7%, where your target's a little over 7%, and then 7 years, your return is 10.3%, beating your benchmark of about 9.7%, and these are net of fee returns. So the last year, unquestionably, has been a much more muted return environment compared to what we've experienced over the last 5 to 7 years. So recall 2000, the bottom of the stock market was in March of '09. And ever since then, we've been on a pretty consistent march upwards. And we're coming on 7 years for that right now. So this 7-year number really captures all of the rebound in the stock market. It doesn't capture the fall that we had leading up to that rebound, nor the run-up that we had before that fall. So it is interesting that you could look at these 7-year numbers, and Ted asked a question about this at the last time we met. It's interesting, you can look at what's really long-term numbers, but these long-term numbers can certainly be impacted by market environments that last longer than 1, 3, and 5 years. A couple takeaways from your managers on pages 17 and 18 is that your domestic equity managers, though in other time periods they've performed really well for you, over the last year and the last quarter, they haven't performed as well as they have in the past. We've talked about your equity structure historically, and there are a couple key things about the way you manage your equity portfolio. One is it tends to be overweight small cap stocks. 2, it's heavily actively managed, right? You've got just a 5% allocation to index funds. Over the last year, active managers have struggled relative to the index, and small cap has not kept up with large cap. So those couple factors have been a bit of a headwind for your domestic equity structure. Another thing we've noted historically is that your portfolio in general tends to be a higher beta portfolio. So when the stock market is up, you go up more than the stock market on average. When the stock market's down, you tend to underperform. When the stock market's down, you go down even more than that, right? You have an amplification to some extent of the stock market in a high beta portfolio. And that's another characteristic that's really noteworthy of your domestic equity structure and the way you're invested overall, okay? A couple quick takeaways for your mid-cap, or for your managers. I'd say that the couple that continue to struggle the most and that we should be most critical of regarding their performance are a couple of your mid-cap managers. Royce Total Return is a mid-cap value-oriented manager to small-cap value-oriented manager. Their last year performance does not distinguish them in a good way, and Morgan Stanley's in a similar situation. So I think those are the 2 managers that we should continue to keep a close eye on. We're not recommending a change for them right now, but if they don't demonstrate an ability to protect the portfolio in a down market or in a subsequent up market, then we think that it's time to move on from those 2 managers. It's great to see that your bond managers continue to do a good job for you. They rebounded nicely in the quarter, even though they did underperform for the year, and that's mostly due to the Dodge and Cox portfolio.
I have a question before I leave the page.
Yeah.
If I can. Are you, in recommending portfolios to other agencies, are you looking at increasing the share that goes to mutual funds or index funds? Because you just talked about the fact that we don't have as much in index funds as we might.
Passive versus active.
Okay, passive versus lower with the lower fees. So are you looking at that as a change?
Well, we've talked to this group before about it. We did this equity structure evaluation, and one of the possible portfolios we shared with you was a higher allocation to index funds. And the decision was made at the time to keep the active managers you have because they had done really well for you over a good stretch of time. And if you look over the last 7 years, your active equity managers have added about 80 basis points net of fees over the Russell 3000 index. But the U.S. equity market is becoming increasingly more difficult to beat from active management perspective. So it makes sense to us to spend your active risk in areas that are the least efficient. We do believe that small and mid-cap stocks are less efficient and is a good area for you to express active We also think there's some really good large cap value managers out there. But you have to have conviction that you are picking an above average large cap manager to have active large cap. Right? It's not just that, oh, I think active is gonna do well in general. It's also, these are the right ones. These are the winners here.
If I may, Mr. Chairman, when you say above average, if memory serves, and we all know how dangerous that is for me to say, when you're looking at an active large cap manager, you have to pick not just above average, but top quartile or top quintile for the outperformance net of fees to work. Is that,
Yeah, I
Does
think
that
that's
mesh
probably
with
about
your expectation?
top third might be,
Okay, top
you know,
third.
something like that.
so not just the 50th percentile, you've got to get in the
Yeah.
well above average in picking the right manager
Yeah.
in the active large cap space, so.
And, you know, I think you've got some really good managers. I think Dodge and Cox and Jennison with the Harbor Capital Appreciation Fund, both world-class managers. They're fantastic.
I think the two we got rid of did pretty well. As you know, I have a very large practice with American funds, and I think both, especially Growth Fund of America, has
Growth
done
Fund of
pretty well.
America.
Certainly Europe Pacific has here as an active management, but all the active management for any length of time with American funds has outperformed the indexes. It has been a very difficult time, I think, since we've had the huge stimulus program and the very aggressive Fed action for active managers to really earn their keep, because everything went down to nothing, everything came back up by Fed action. But over time, I mean, American funds uses rolling 10-year periods, and they've proved they've always been able to bring value to the table above
Yeah.
their fees.
And you have Europac in
I know
international
we do, and
equity.
this
And
outperformed,
they've
it
done,
did, certainly
they've
did last
done-
year. Growth Fund of America did very well
Yeah.
last year too, and I think
Yeah.
ICA did okay too compared
Yeah.
to indexes.
yeah.
Which ICA and Growth Fund, we both got rid of when we went to more passively managed funds.
The S&P 500 fund.
Not saying we shouldn't have passive, but good active managers have earned their keep over time.
You just have to be confident you got the right ones.
Greg, footnote number 4 on bookmark, it says switch to CIT in the words. Bottom of this page.
So that's an investment vehicle type. So that's a collective investment trust as opposed to the 40 Act fund. I'm gonna check that footnote. I think that, is that alluding to AB?
No, it's Oakmark. They went from mutual fund to a community.
Oakmark did.
Mhm. In the fourth quarter.
So that's your Harris International Equity Fund.
Yes.
So periodically, these footnotes allude to time periods where we've moved to cheaper share classes that are available to you.
I didn't know what a CIT was. So.
Yeah, that's a collective investment trust. So you've got a couple collective investment trusts. Boston Partners is a CIT. Mondrian is a CIT. And those tend to be slightly cheaper ways to pool assets together. Only institutions can go into it, and they don't have the costs associated with 40 Act mutual funds. Okay. We have our attribution pages which explain the reason for performance, and you'll note that,
Is that me, Mr. Chairman?
oh, sorry.
Greg, before we leave the asset allocation overview, you mentioned that our fixed income managers are doing relatively well, have done their job. We have 3 managers that are on our continue to monitor list, 2 of
Yeah.
which you mentioned, Royce and Morgan Stanley, but PIMCO is also there.
Yeah.
Can you touch on how they're doing with their organizational issues? Has the bleeding stopped? I'm not hearing anything about PIMCO anymore, so
Yeah.
can you give us a brief
Yeah,
update on
yeah,
that?
thanks for.
Is it time for us to take them off the list, or what?
I think they have stabilized from a asset perspective, from a client retention perspective, so, and they've always been a very large firm, so it's not like they were gonna go out of business at any time. But they did have one or two investment professionals leave, their head of risk management analytics and Veneer Bensali. So that was a disappointing departure they experienced. But I think from an asset flow perspective, that is stabilized. And you'll see that they actually have done pretty well in the last year, performance-wise. And that will go a long way to stem outflows. Should they be taken off the watch list? Yeah, I don't foresee us making an argument that they need to be replaced anytime soon. But if, something happens with the team, more people leave, or something else happens with the org, we would certainly come back and be quick to put them back on a watch list or recommend a change.
Greg, I got a question. On page 20,
Yeah.
it shows the last 3 out of 5 years we've missed our benchmark. Is that our product of our active managers or just our asset allocation? Or
So the way I read it is the last 2 years you've missed your benchmark.
but then 2011 we missed it too.
All right, so 2011 you missed, and then 12, 13 you exceeded, and we don't have 7, 8, 9, 10 here. So 2014, I'd say 2015 you essentially matched it, right? So the question is, what happened in 2014? Recall you had international equity managers who underperformed. You'll see that the target allocation was 3.5%, let's say, and your managers negative 3.5. Your managers were negative 5 3/4. And that was because at the time you had that Janus Overseas Fund. The Janus Overseas Fund left a mark in 2014 on the portfolio. That was the main driver of underperformance in that year. Your bond managers also underperformed a little bit. PIMCO in particular had a tough 2014. So it was mostly the managers during that calendar year 2014. 2011 was also your international equity managers. And again, that was an example of where they're a higher risk component. So when that market is down, they're down more. When the market is up, they're up more. And you'll see that pattern really holds out in 11, 12, 13, and 14.
Thanks.
Okay.
So beta and alpha would both be in management effect on page 21?
Yes. So manager effect measures how well did your composite do relative to its index. And what we're calling asset allocation effect is your decision or the happenstance that occurs when your actual allocation differs from your target allocation. So which page were you on, Ted?
I was on page 21, manager
21,
effect. It
yeah.
looks like it was alpha and beta.
Yeah,
It
so,
wasn't just pure management picking of stocks, it was, had to do with the volatility of those stocks.
that's right. So that negative 43 basis points for your manager performance in domestic equity is, I'd say it's because you have a small cap tilt, and it's a couple of your active managers, Royce and Morgan Stanley in particular,
Pick them all.
contributing to that. Yeah. I think that's kind of a general summary of performance. Are there any individual asset classes you want to get into, or any other topics you want to address before we talk about capital market overview?
The small cap tilt. You recommended one thing, we stayed or went the other way. are you telling us, or do you suggest we revisit not having so much of a small
Yeah.
cap tilt?
I want to be clear that this board did not approve anything that we weren't supportive of.
Okay.
So it's not like we came in here guns blazing saying you should do this and you did something differently. It's just that when you have a collection of active managers and you have dedicated allocations to mid-cap and small cap, that both of those two forces tend to push you into the lower capitalization range, right? So you know just the way you put the portfolio together, it does. So your weighted median, your average portfolio, the market cap of the average stock in your portfolio is 30 billion, with the index it's about 52 billion. So you do have more exposure to smaller cap stocks. I think it would be useful after we do the asset allocation study to come back and look at the way you have all your domestic equity assets. And we've talked about it in the past. You now have a custodian, and historically you have needed to be in only funds because you didn't have a custodian. Right? Now that you have a custodian, it is possible for us to look at separate accounts, and there might be a fee savings if you move to separate accounts. And I think that's a useful exercise for us, at least to walk through and take a look at. And it might show that, no, the fee savings is not material, but now that you have a custodian, I think that's after you do the asset allocation study, to me, that's the next logical thing to take a look at.
Thanks.
Any more questions? Fred?
Gonna write a quick note. Okay. So we have another presentation, and it's called 2016 Capital Market Discussion and Projections. And I'll go through this maybe in the next half hour, 40 minutes or so. And at the end, after hearing all this information, I will say that you don't need to do a thing.
We like that.
So I just wanted to preface that, because a lot of times we walk through and we talk about the market and we'll say, here are the headwinds, and people might react to say, oh my gosh, there are a lot of headwinds right now, and there are always headwinds. But what's important for you is to be knowledgeable of the risks out there, of what could happen in the capital markets, but not necessarily react and overreact on a timely basis, right? You have a long-term investment policy, and it's designed to weather down markets and take advantage of up markets, okay? And we'll talk about some things here that are certainly headwinds. We've had a pullback in the stock market on a year-to-date basis, but we don't think you need to be going out making a dramatic shift right now to your asset allocation, okay? With this presentation, we're going to be on pages 2 and 3. And I'll just provide a framework about the genesis for this presentation. So on an annual basis, we come up with our long-term strategic asset allocation and our long-term expected returns for broad asset classes. The purpose of these return forecasts is to be a tool for long-term strategic asset allocation. Okay? We're not trying to predict what's going to happen to the market in the next year or 2 years or 3 years. That's a very difficult thing to do, and I think there are very few people who can actually do it and do it well. But we think it's reasonable to come up with what is our expectation for these asset classes over the next 5, 7 to 10 years. And that's a useful framework for you anyway, because that matches up with the time horizon of your investment program. It's a long-lived investment program. Also coming up with capital market expectations. It verifies what your expected return on assets is, what the volatility of those returns will be. And anytime you do an asset allocation study, it is the cornerstone of a prudent process of being a fiduciary and an institutional investor. These projections that we have at the back of this book take the history into consideration, they take relationship of asset classes to each other into consideration, and they take current valuations into consideration, among other things. We come up with expectations for broad asset classes, US large cap, small cap, international, emerging, but we're not predicting what's going to happen to biotech. We're not predicting what's going to happen to smaller sectors of the market. Those aren't the sectors you allocate to anyway, because you allocate to real estate, international, domestic, bonds. Those are the buckets that you actually decide to allocate to. We think it's best for active managers to make those allocations to, subsectors. They're in the market on a daily basis, and they can make those investments on a timely basis. Okay, so on page 5, there were a number of themes we explored when we were setting our 2016 expectations. I mentioned earlier that in 2015, most capital markets were relatively flat. They weren't pronounced largely up or down. Nevertheless, with a flat return over the year, we looked at most broad asset classes, and they looked either, about fair value, and we'll have some statistics in here, or some of them continue to look maybe just a little bit overvalued. They're at the end of the year, beginning of this year, there really weren't any screaming buys out there, if you will. There weren't a lot of distressed assets that were far from what we thought their fair value was. At the end of the year, when we're making these expectations, in December, we had the first Fed rate increase. And another question that we had to deal with is, okay, what is the path of future interest rates that the Fed is going to set? And what's going to happen, and they control the short end of the curve, but we also had to question, okay, what's going to happen to the long end of the curve? Will they move in sympathy, or will they actually move in opposite directions? And there are a number of scenarios that one could come up with that you could see that coming out. Another scenario is that non-US equity markets have lagged the US counterpart for a number of years. And if you looked at emerging market equities, they have been very good for about 5 years straight. At what point is this going to turn? Is a big question that we're dealing with. Because if there's anywhere that valuation seems a little more reasonable, it's that part of the market. But you certainly have headwinds of currency and a slowdown in growth rates in those markets. So there's a reason that their valuations are a little lower than they have been historically. On page 6, we show.
Greg, I got a question. On
Yeah.
your major themes, you've got a slide later in the presentation looking at labor force participation and
Yeah.
unemployment rates side by side. And my question is, I think a broader theme is, did you consider, are you talking about the increase in the so-called collaborative economy and what that means for the U.S. economy as a whole? Or is that something that you're aware of, but you don't think it's really having an impact on the investment world per se?
It's real. I forgot the term I heard for the collaborative economy or the on-demand economy or whatever it is.
On-demand gig economy, whatever.
The gig economy, that's
Yeah.
what I read today.
Yeah.
I think there are a few things going on. One is the workforce participation rate very well may not capture some people who are gigging as opposed to being employed. The gig economy can have a downward impact on wages and the cost of labor in general. The gig economy doesn't have benefits.
What is it?
Oh, so the gig economy is like an Uber driver, let's say, or someone who is renting out their house, or something where
Airbnb and.
it's a less traditional workforce. I'm going to work somewhere for 5 years and I've got benefits, and so the benefit cost for them is not there. But keep in mind, if they're not getting paid those benefits, that there are certainly implications on that. So the gig economy has no retirement plan. The gig economy doesn't have a DB plan, let alone a 401k plan. And to me, that's one really interesting thing to think about.
They don't have a formal one.
Um,
They don't have a formal retirement fund.
r-
They may
right.
have an informal. whether
It,
it's
meaning
a
that
Roth or
they
a-
save the
You
money.
can have an
on their
IRA.
own.
Yeah,
but you
they may
can't
have
put
a
it- can't put it in an
separate,
IRA.
simple, or they may be
Yeah.
putting it
Or
in
separate.
something else, maybe putting it
They
in some
might be.
other asset.
But
They may be putting in bricks and mortar.
they could be. But what's tough with, you know, if you look at behavioral finance and what individuals, what's the average Joe do, is they don't save unless they're forced to. You know, so a lot of people in the so-called gig economy, they have to be extraordinarily disciplined and unlike the rest of the population to actually put money away for retirement. And there's certainly gonna be some that do it, but I think the majority of them aren't. They're just, it's gonna be money coming in, money going out, and they're gonna have a harder time saving. If you look at if you look at a 401k plan for a company, and if you don't auto-enroll them, the participation rate can be very low. But if you force them to enroll, they actually do it.
I manage a lot of 401ks. You match and you get a pretty good participation.
That's right, or you can force them to do it. And it's not that most people are really adverse to it, it's just that they don't know how to do it, they don't
The
have the
incentive of a
discipline to do
match
it.
brings everybody to the table,
Yeah,
because you're leaving free money if you don't.
it's irrational not to do it. Right?
They'd have to have a good reason not to do it.
Yeah, yeah, indeed. So yeah, I mean, that is a factor, and it does explain just a little bit of the workforce participation rate coming down. But there are also powerful demographic trends affecting that as well. On page 6, we showed the calendar year returns here earlier. A couple notable items I find on this page is you'll see the bear market in commodities that is going on for 5 years now. This has powerful ripple effects in the economy. It's something that you've seen a lot of people talking about in the last several months, is that any company that is in the business of producing, delivering, transporting commodities has less money today than they did previously. Any bank that lent money to those enterprises could face losses. Any investor who lent money to those companies could face losses. So there's a point where low commodity prices, low oil prices is beneficial to all of us because it's a tax rebate to all of us. But to the point where it gets so low that it's doing damages to the company and the financial sector and the whole sectors, it becomes a drag on the economy, more powerful than the stimulus of more money in our pockets is. If you look at the 5, 10, and 15-year returns on the right on page 16, you'll notice that we've actually had pretty robust returns in the stock markets over these time periods, and muted returns for bonds, 3, 4, 5%. But they're not dramatically far off what most people expect to be long-term equilibrium returns for broad capital markets. On page 7, I think I shared this chart with you the last time we were together, and it puts the U.S. stock market in the returns of the U.S. stock market in increments of 10% return buckets. And here you'll note that over the last several years, 10, 11, 12, 14, and 15, skipping 13, our returns for the stock market have been right in the middle of the distribution here, the most average of returns between 0 and 20%. Notably, they've all been positive. The last time we had a negative return for the U.S. stock market was that 2008 time period, where the market was down over 30%. Notably, that is not a common occurrence. There are only 5 other calendar years where we had a return that bad or worse. But it is an environment where you just have to be aware that an event like that can happen, even though it's not close to the norm of happening in the U.S. stock market. On page 8, we start looking at the bond market here, and the red line is the yield curve at the end of 2015. It's notable how much the short end of the curve, the red line on the left, how much higher it is than the other bars, the other lines that we have, which are the calendar year yield curves. The yield curves at the end of the other calendar years that we're showing on this page. And notably, the short end of the curve came up because the Federal Reserve started increasing interest rates. In a few pages, we'll show the dot chart, and I'll explain what that is when we get there. But note here that on the red end, on this red chart, that the highest part of the red chart is about 3%. So a 30-year Treasury at the end of the year was yielding about 3%, and the 10-year was a little over 2%. I mentioned that earlier. Let's just keep those numbers in the back of our mind. We'll look at what the Fed itself is predicting short-term interest rates will be in the coming years. On page 9, we start talking a little bit about the U.S. economy, and if there is any bright spot across the globe, it is the U.S. economy. It's not gangbusters growth, but it is positive, consistent growth, and it's growth that we've seen for a number of quarters now. The GDP for the year came in at about 2.5%. Unemployment, we all know, is about 5% now, which a lot of people historically had called full employment, meaning that 5% of the people without a job who are looking for a job is just the frictional number of people who just come, leave a job, join a job on an annual basis. So that's very supportive and that's very strong and positive for the U.S. Growth. There appears to be modest growth in Europe, but that's after pronounced stimulus by the ECB, the European Central Bank, to push this growth forward. I mentioned energy prices, and that is certainly a headwind for the U.S. economy currently. You probably you'll see when you look at the financial news that the price of oil seems to be highly correlated to the price of stocks right now, and it's for a number of the issues that I alluded to earlier. Final headwind for the United States is that China seems to be off its previous torrid pace of growth. But what that means is that growth rate is 6 or 7%. It's still robust growth, but it's just not as robust as it had been historically. U.S. economic exposure to China is limited. It's there, but it's not huge. Exports aren't as large of a component of the U.S. economy as it is in a place like Australia, where they're much more impacted by a slowdown in growth in China. On page 10, here's a snapshot that takes a look at GDP in the United States over the years. You'll note that we have that big drawdown in 2008-2009 time period. So that's the financial crisis, where we posted close to -3% if you combine 8 and 9 together. So the economy contracted over that time period. And ever since then, we've been plugging along at this 1.5% to 2.5% growth rate, where a lot of people are talking about this so-called new normal of lower returns. It's based on this growth rate being lower than what you see to the left of 2008, where a lot of times you see growth rates north of 3 to 4%. So there seems to be a deficit now going forward than what we experienced in the past. And notably, we continue to be working our way out of a financial crisis that has implications on growth. And it certainly has been a limiting factor on U.S. GDP growth historically. GDP has been bouncing around, but notably unemployment growth has been in that 2% range. So this is the growth of payrolls, if you will, in the United States. And you see that we've been pretty consistently since the financial crisis chugging along at, that blue line is, 2.5%. So steady, slow and steady growth, not gangbusters, but slow and steady. On page 12, this is the chart that James was alluding to. And on the blue line here, we have the labor force participation rate. So this is a measure of the people working or looking for work who are of working age. And you'll see that the participation rate peaked in that 90 to 2000 time period, where we were about 65% of population in the workforce. Since this time, we have fallen now to about 61, 62%. So that's a 4% of people that aren't in the workforce anymore, percentage of people. And this is notable because as you have a higher percentage of non-workers to workers, it just puts more strain on the economy and it's harder to grow. One thing that this chart doesn't capture is the total workforce. The total workforce, this doesn't mean the total workforce is declining because you have population growth and you have immigration. It just says of those who are eligible to be working, what's the percent of them. Notably, the gap between the green and blue line is narrowing, and this is essentially the gap, the distance between these two is essentially what the unemployment rate is.
So when it says percentage of population age 16 and over, has that upper age gone up over time? Because it does seem that people are generally working a little bit longer than they were, say, 30 years ago.
Yeah, so people are working longer than they were before, and there are a number of powerful factors pushing
But
that.
does this reflect that change?
You know what? I'll have to check to see what the upper limit is. So this clearly doesn't capture 90-year-old people in the workforce. I don't know if it's 65 where they cut it off or 72. So I'll have to check that detail.
The main question, I was curious if they changed it during the, because this is going from 1964. I'm just curious if they adjusted that over
I don't
time.
think they did.
Okay.
I don't think they did. So this is, this sort of thing.
I'm thinking it's everyone 16 and over, and that's why it caps out at something like 65%. So it's including all the retirees.
Working.
Yeah.
It's percent of
You know what, you're
population
right, you're right,
aged
you're right.
16 and over
You're right.
that are working.
Mhm.
So it's the population that is 16 years and older is your divisor, and your numerator is the number that are working, or on, that are on a payroll,
Mhm.
the number that we can measure are working by the BEA.
You're right. I was thinking of the employment rate where they excluded people not looking for work.
Right, that's a different animal. This,
Right.
the labor force participation is all people.
Right. So if you have more retirees,
That number goes
then
down.
the number comes
And
down.
baby boomers retiring.
Right.
On page 13, we have average hourly earnings. So this is the average the metric that measures the average salary someone is bringing home. And since the financial crisis, it's been really flat. And this is both an economic issue and a political issue, that wages hasn't increased. But notably in the past year, we did start seeing a slight tick up. And as unemployment rate comes down, you should expect wages to feel some sort of pressure to come up. So one of the things that the Fed is concerned about is not only employment rate, but it's also aggregate inflation in the economy. They have a dual mandate to manage these two things. On page 14, we'll start looking at inflation rates, and you'll see that core CPI, the thing that excludes food and energy, has been remarkably stable for the last 7 years, pretty close to that 2% rate. It's only when you take in food and energy that you'll actually see the sharp drop off in inflation over the last year or so. But the Fed is going to focus not on CPIU, not on that measure that includes food and energy. They're going to focus on core CPI, which is thought to be the more powerful, long-standing inflationary factor within the economy. So this information and inflation on page 15 certainly indicates that the Fed feels that we are close to that 2% threshold, which they are certainly targeting regarding inflation. On page 16 is a different way to look at average hourly wages. So their wages and salaries on green, and there's total compensation on blue, and total compensation differs from wages and salaries in that it includes benefits. Notably, part of the inflationary factor that we've experienced over time for the cost of having an employee has been on the benefit side. A huge component of that is healthcare related costs going up through the roof. So as companies, as healthcare costs have become more manageable on a growth rate going forward, companies might have a little more ability to start spending, passing money through to employees in the form of salary raises as opposed to the benefits, which has been taking some of the otherwise where they would be getting a raise historically from an employer.
So does this count as deflation?
Well, last year, there was certainly a point where it looked like there was deflationary factors in the economy, and that was a lot to do with the oil. The price of oil coming down and energy coming down in aggregate.
Since utility here, is this an oxymoron, affordable care will boost cost of benefits?
Workers' comp could accelerate as labor, yeah, affordable care will will boost cost of benefits.
But they were gonna reduce cost.
Well, I think they should, you know what, our Jay, I think Jay might have a typo in this chart, so I'll ask him about that. Here on page 18, here's what I think is an interesting counterpoint to the price of oil going down, which is certainly highlighted on page 17. So the green line here shows the retail price of gasoline. You see it's volatile, it's going up and down. And then on the blue line, it's the average household spending on gasoline. So in the past, 2010 to 2014 time period, the average household spent about $3,200 a year on gas. And now we're down to about $2,000 a year on gas on average for the average household. So $1,500 a year, I mean, that's a pretty good dividend to every person in their pocket right now, just because of the price of oil dropping. The only question we have is that are we doing damage to the employment rate of others? Because there's certainly going to be a number of energy-related companies who are going to have layoffs and restructure their companies. Let's flip ahead to page 20 and start talking about the housing market. We note that energy will be a headwind to some extent in the U.S. economy and the global economy for next year. The housing market appears to be stabilizing and appears to be a tailwind for the economy at this point. It's important to note that we talk about the housing market as if it's one homogeneous market, but I think we're all in a part of the world where we know that some housing markets are very different from others. Even within California, let alone California compared to Nevada, compared to Indiana, where I went to high school. They're all very different markets. But on the plus side, mortgage rates remain quite low. Foreclosures are declining, job creation is sustainable, the rental market is tight. These all should be supportive of the housing market going forward. There are some headwinds though, and that is household formation continues to be suppressed. And there is a bias we have now, and especially with younger people, that owning a house is risky. Right? And that's certainly a generational change compared to what all of our parents thought what the American dream was historically. So on page 21, we have a number of statistics regarding housing. A couple of the interesting ones I found are housing starts on the upper left-hand chart and the house price index in the green. You see that the house price index measures that the average house in the United States is back towards where we peaked in the 2007 time period. But housing starts, so the creation of new houses out there, remains at a much more muted level, though it is positive, but it's a much more muted level than what we experienced in that 2005 time period. Affordability of houses spiked up after we had a crash in housing and a fall in interest rates. But as interest rates pick back up and as housing prices rebounded in value, the affordability index certainly has been weakening in the last year or so. So that's housing, and you'll see a chart in a few pages that notes the size of the housing market and importance of the housing market in the U.S. economy. It is a huge multiplying effector in the economy because if you buy a new house, you often paint it, buy new furniture. So there's a multiplier effect, and that's why housing is so important. Consumer spending, the consumer remains 2/3 of the U.S. economy. The positives for the consumer is outweighing the negatives in our point of view. There are headwinds. Wage growth has been slow, as we took a look at. Young people in particular have high student loan debt burdens. That's a headwind on their ability to spend money to buy goods and services. Savings for retirement is a underappreciated need for the economy, and as more people have their 401k plans, they're going to have to start putting money away on their own, which could be a headwind for them actually spending the money today to propel the economy. Now, there's certainly positive forces. We mentioned job growth, consumer confidence is improving, low energy prices, and we have slightly rising disposable income in general. So that's a quick look at the consumer. How about another part of the economy, and that's corporate America? Corporate America remains quite healthy. On page 24, we see profit margins on average for corporate America. And ever since 2008 time period, we've been quite elevated, and we are high compared to historic averages. And part of this is cost containment within corporate America has certainly been driving up profit margins. So companies have this money. A lot of them have money sitting on their balance sheets, and they're going to be spending that money on something, paying off their debt, buying back their stock, buying another company. So we think there is a little factor in the stock market that there is a cash buyback component that in addition to the dividend yield, that you have another additive component for the stock market going forward will be, companies paying a premium for other companies' stock prices, or them buying their own stock back. All right, page 25. I like this. It's a busy chart, but I think there's a lot of great information on here. On the left here with the square, we show the source of GDP, so gross domestic product, so the goods and services created in the United States. And we show it, the percent, how it's broken down in 2006 and 2014. And you'll see that it's relatively consistent that consumption, the consumer, is about 68-67% of GDP. So of all the things that happen that drive GDP, 2/3 of it comes from the consumer. Residential investment, so this is housing, and you'll see that percent of GDP, it was 5.5% in 2006, it's now 3%. So we've had a decline in this being a component of GDP, and it's notable that from 2007 to 2010, this was a marked drag on the GDP growth. Big negative numbers, negative 20%, 24%, 21%. And ever since then, we've slowly started dragging our way out of this. So we think we're at a point where this could be additive going forward. Business fixed investments remains about 13%. Federal government as a percent of GDP is actually down ever so slightly, 7.3% to 7% over this time period. And state and local governments is down 12.4% to 11%. You see that notably, state and local governments from 2010 to 2013 were negative impacts on GDP. State and local governments were spending less money than they did the previous year for about 4 years straight. Notably, in 28 and 29, the federal government was spending more than they were historically, so that's the stimulus that came out. But ever since then, 2011 to 2015, the federal government has been a net negative impact on GDP growth.
So when you see the years and you see those numbers down for each of the years, is that the change? Like if you look at federal government in 2008, is that 6.8? Is that the change from the prior year?
That's the percent change from the prior year. So if it was 7.3, that went up 6%. Yeah, so it's the change of their contribution to GDP, if you will.
How do state and local governments the gross domestic product? But they don't build anything,
Well, some state and local governments do build things. They spend money.
It's spending money, it's based on money.
they're spending
Roads.
our money.
Well, new,
Yeah.
even like as simple as new desks,
Yeah.
stuff, office stuff. I mean, anything, yeah, any
Or,
spending, right?
you know,
Supplies.
I kind of wonder if, a train would fit in. If we build a train in California.
Yeah,
Right. So that's the government spending money.
Yeah, the train to nowhere.
Here we look at exports and imports. The split, the difference between exports and imports has improved for the U.S. over the last several years. Exports used to be 10% of the economy, it's now 13%, where imports are essentially flat at 15.7% over this same time period. Over the last, so this is over, 2006 to 2014. Imports have grown more quickly in the last year than exports have, and that's because of the U.S. dollar. So we do think that there will be a gradual acceleration in the global economy over the next year, but there certainly are downside risks. On the bottom of page 27, we'll note that our forecast for U.S. growth is that 2.5% range. We think inflation is going to be about 2.25%. Non-U.S. growth, so developed, so this is looking at Europe, Japan, Australia, Canada. We think growth is going to be a little less than that, about 2%. Their inflation is also going to be a little less than at 2%. In emerging markets, we're predicting the GDP growth of 5% and inflation also of 5%. So this is real GDP growth. Notably, that 5% growth rate is lower than what we have seen in the past from emerging economies. On the bottom of page 28 is we start talking about the Fed. I think one of our concerns about the Fed going forward is that they don't have a lot of ammunition left. If we go into a pronounced downturn, there are comparatively few things they can do. Fed funds rate's at 25 basis points, maybe they could cut it. It's possible they could go negative, but going negative on short-term interest rates could do its own form of damage to the economy. Think of the money market world out there. So every little investor has to pay money to have their money sit in a bank.
Yeah.
I mean, it could be very destructive.
Yeah,
Are they doing that in Japan now?
Yeah, well, they're
Growth.
negative 0.1. Yeah, and they're experimenting with it, but it also just closed the money market world overnight, and that'd be extremely disruptive. Other thing they could do is continue quantitative easing. But we're getting to a point where they're pushing on a string. We already have a 10-year treasury at below 2%. How much lower could it go, and would that actually be stimulative in the economy if they did move it? On page 30, this is the dot chart I alluded to earlier, and I noted that, keep that 2% and 3% numbers in mind. So what this dot chart shows is what the members of the FOMC are predicting Fed funds rate to be over the next few years. So each dot is a member, and it's saying, okay, what's your best guess the Fed funds is going to be? And so they all pegged it at the end of 2015. That's going to be a quarter basis point. It's good because that's when the survey was taken. But you'll see a couple takeaways here is that within each year, there's meaningful dispersion of the people who actually have control over the Fed funds rate. In 2018, some people think it's going to be 2, some people think it's going to be about 2% higher than that. So even the people on the committee have a big disagreement with each other about where it's going to be. So it's far from unanimous. But also, if you look at the average measure here, let's say at 2017, about 2 years from now, it says on average, the average person thinks, on the FOMC, thinks that the Fed funds rate is going to be about 2.5%, which is above the 10-year treasury today and not far away from the 30-year treasury right now. So that either means that this projection's wrong, or the long end of the curve doesn't value what's going to happen to the Fed funds rate, or that there's some other force moving these two yields differently from each other. Or maybe it's a combination of all three.
Well, just the fact that we've been told that interest rates are going up in 2 years, we've been saying that, and we said that since 08, right, or 09.
Yeah.
And it keeps getting moved out further. I don't think the market's necessarily irrational yet. We haven't seen it, right? When we see it, markets react pretty quick.
That's right. And the market
That
did
can
move up.
change overnight very quickly.
It could. Now, it's interesting to me that there are a lot of investors out there who really want that long end of the curve. Insurance companies, pension funds. We could be in a scenario going forward where those types of investors, where there's limited supply, high demand, push down the long end of the curve, and the short end of the curve just acts different. So that's academically interesting, but it does break some models out there that that assumes there is a term premium in investing in bonds, that you are paid more money for taking on this duration risk. And if that happens, it would kind of break some of those basic economic models out there.
Those still have to be relatively short term, I think. But long term, it would have to reestablish yourself. Question is, what's long term?
Right.
Is it a year, or is it 5 years, or more?
Right. Let's take getting a little long in the tooth here, so let's look at a few valuation pages. On page 33, this looks at just one measure of valuation in the stock market. This is the PE ratio, so the price you pay for a stock divided by its earnings. So at the end of the year, we're running about 18% price times earnings. And it's just a little bit above long-term average. It's about 17 times. I think I said percent, I should say times. So U.S. stock market, looks pretty close to what it has been long-term. Notably, since this chart, the stock market's down over 10%. So we're probably closer to that 15, 16, or we're probably closer to that 17. But PE isn't just price, it's also earnings. If earnings comes down, then that PE multiple goes back up. Next couple of charts note that corporate profits and growth in dividends are both strong and above average. Let's look at PEs on page 39 for international market. And you see at the end of the year, they were at 15. so a little less than the United States, and pretty darn close to their long-term average. And again, this is before a drop in the stock market, in the international market of about 15%. So now they're certainly slightly below their long-term averages, but not dramatically below. So again, we're looking at a situation here where valuations don't look dramatically different from what long-term averages show. Now on page 42, we look at the emerging markets. And
40 or
42. I've been talking too much. So on page 42, we have emerging markets. And here, this is before a 20% decline. You're down at a 12 PE before that, and long-term average is about 5. So this is the one area where it looks like there is a little more value, if you will, in the market. But as we stated earlier, there are reasons that is price display. Currency is a component of that. Slowdown in growth. I mentioned China is now 6, and so that is certainly causing in part the reduction in PE. On page 46, we have our expected returns in all of their glory. And after this exercise, we did lower our expected returns for most stocks out there by about 25 basis points over a 10-year horizon. So U.S. stocks, international stocks, emerging market stocks.
You lowered them from what your projection was last year?
That's right. That's right. Bonds remain relatively same. Ag bonds at about 3%. Real estate, we brought down a little bit as well. Cap ratios in real estate, we didn't show that in here, but they are quite elevated. So we did bring down our expected returns slightly in real estate. All this means on page 48 is that when we look at your portfolio, we have the target at the top here. This is some information we shared with you just a few weeks ago. We have a 10-year expected geometric return of about 6.6 and a 1-year arithmetic return of 7.3. So this is beta. And we didn't show it here, but our inflation expectation is 2.25. So with that, you could do the math that we expect a real return of a little over 4% over inflation. So this is what we think will happen on average compounded return over 10 years. It doesn't show what we think could happen on any individual single year. And that's something I thought we should share with you. And that's on page 49.
Before you go there, I'd like to just bring one thing up to this board. So when we look at their projection for 10 years, this is a gross rate of return of 6.6%. If we go to our last Galena's financial audit here, and we take a look at what it costs us for administration and investment expenses, 37 basis points. So that means our expected net rate of return, which would compare to our target rate, is in the 6.2% range. That's all I have to say.
If I may, Mr. Chairman. If you think about the real rate of return, which is what we really care about, the 6.6 minus the 35 basis points
37.
puts, okay, 6.25 range. If you take off the expected inflation rate included here in the capital market expectations, that puts it at the 4% range. Like Paul said during the presentation during the joint board meeting last month, if you think about our actuarial assumed rate of return, we're assuming a 7.25 compounded return and a 3.25% inflation rate and a net of fee real rate of return of 4%. So the 6.6 listed here in real terms, when you break out the fees and the expected inflation, matches very well with our 7.25 assumed rate of return on the actuary side because they've got a higher inflation rate. So the real is what really matters, and both have the same expected real rate of return. I mean, tell me if I'm missing something.
I disagree with you, but this isn't the place to have the discussion about Siegel,
Okay.
about our actuary.
Okay. Greg, the
Uh,
real rates seem very comparable there?
Yeah, I haven't seen that report about what they're reporting, but yeah, we would say the real return here is 6.6 minus 2.25, so over 4. Does that 37 basis points, is that for the administration, or that's not the investment manager fees?
Well, if I look at investment expenses here, and that includes you guys, it includes
Yeah.
Siegel, includes, that is 13 basis points.
Okay,
If I take the administration expenses of this body, it's 24 basis points. If
Okay.
I add those together, and that's based on the value, the high value, as of the end of June, where we had $444 million.
okay. I just wanted to make, so our 6.6% return says, okay, if you invested in index funds and you took a net fee return on an index fund, this is the return you would expect.
Yes.
Right. So you're not commenting on, Dodge and Cox fee, anything like that in your.
The ones that we pay directly and other items that go on our financial audit, our books, as in investment expense, which, as I said, includes you guys, it
Right.
includes Siegel, it
Right.
includes some other stuff. That is what I'm using for investment expense. So
Okay.
I realize that mutual funds are reported net, and I
Yeah.
treat it that way.
Got it, okay, I see. Now, hopefully, if you have active managers, and you have them because you expect them to produce a return above their index. So if you have them, you would expect the 6.6% return to be actually higher.
Right.
I mean, that's why you have the active managers. But we publish a 6.6 because it is the index fund return. It is what you truly could just go out and implement on your own the most effective way.
Ms. Schotler?
And now Siegel, though, they don't look at anything for 10 years, right? I mean, aren't they looking out 30 years and 40 years? Isn't that what they're?
They're, my understanding of their process is they're looking at the capital market expectations from Callan and other investment advisors and coming up with what they think is a reasonable, very long-term
Okay, because that's
expectation
right.
based on that, thinking about the 30-year period.
I have another question. So I was reading in the Wall Street that it's not out of the question that gas could get to $1.
It has. In
It-
some
it
places in
has?
the nation this last week.
Oh, my gosh,
It's been
okay.
lower than $1.
Okay,
Not here.
not here.
$1.90 for Frank.
But anyway, do you foresee that, you talked about the correlation between that and the stock market, do you see that as a really, really high risk for the stock market if we still continue with this oil dropping like we're seeing?
I think there's the risk you should be concerned about is that the dividend produced by low oil prices going into all of our pockets is not strong enough to outweigh the job layoffs,
And what's-
the bankruptcies, the disruption caused by anyone touching the energy sector that's facing. So Chevron is a huge employer in the Bay Area, and their margins just have to be really different today than they were before. I read one statistic that, and there's no way I could verify this, but it said, okay, if you had oil at 110 and you have oil at 30, that 80-point difference, you multiply that times all of the known reserves out there, and that's $100 trillion. So think about that
Wow.
number, it's $100 trillion. That's someone's balance sheet. It's someone's asset has gone down that much, and what are they gonna do on the other side of the balance sheet to make it work? So, sovereign wealth funds have been selling their stocks.
Because they need to, because oil revenue's down. So they've been unloading reserves and stocks.
Exactly. So that's been a contributor, one of the contributors to this sell-off in the stock market. Is that you have these huge holders of assets who are saying, okay, I don't have 100 trillion anymore on the balance sheet. Supporting spending in my country. Saudi Arabia, 70% of the population is 30 or younger. And a lot of them are accustomed to pretty cushy jobs with high salaries and, So, there are significant issues those countries are facing. And, in a very unstable part of the world. and they are selling assets to, you know, to make up the difference.
And I would add, having some personal exposure as well to some of the energy companies, there are very real impacts. I mean, Devon, one of the largest energy companies in the country, announced yesterday they're laying off 1,000 people. You know, and they are one of the most conservative energy companies, and they're in a place where they're having to cut 1,000 people.
Yeah.
I mean, there are other energy companies headquartered in Oklahoma that have simply gone out of business.
Yeah.
Who was it? Was it Sandridge that got delisted a few weeks back?
Yeah, I didn't see that.
I think Sandridge got delisted from
Yeah.
the stock exchange.
Yeah.
It's bad times in the energy sector,
Yeah,
and that has ripple effects.
And lots, yeah, on what you're saying, lots of money there.
yeah.
So,
Okay, I think we're just about out of time. A couple more questions.
I was just gonna say, but on the other hand, the airline industry's record profit.
Yeah. You know,
But they're passing them all on to us.
There you go.
yeah, the one thing I'd like to point out real quick is that, so we project a 6% return on average going forward. On page 49, this shows the distribution of what you could experience in any one year though. So a lot of times you hear, oh, it's a 7% return, you're just gonna hit that batting average every year. But with the volatility of the market, the standard deviation is the counterpart of that return. We think over any 1 year time period, you could have a negative return of the portfolio of negative 10% to worse. So that's just 90% of the time. So 1 out of 10 years. We haven't had a year like this in a while. And this is the 90th percentile. It's not the 98th percentile. All right, so we expect, you know, we do expect returns over the long run to be that 6.5%, 7%. But to get that, you have to be able to live with a negative 10, 15, 18% return for the portfolio in any one given year.
You don't get Bernie Madoff's return?
And it's why a geometric rate of return is what we should be looking at rather than the arithmetic rate of return.
Mr. Wilbanks?
before we leave the agenda item, I just wanted to get some board direction that make sure we're all comfortable with taking PIMCO off of our investment manager status update list. Unless there's, and based on the recommendation from Caroline. Okay, we'll consider that board direction.
All right, any more questions for,
Well, I asked to go back to the, our portfolio change, page 16. I'm not following the math on, it looks to me like we took 600,000 in cash. We took $1 million from the fixed income, but we gave $3 million to Mondrian. Where'd the other $1.5 million come from?
Do you have employer contributions in the quarter?
We are net negative on that. I think, is that that may be a timing effect because we, and Stan, help me out here if I'm misremembering this. We terminated the other manager, Janice, and that rebalancing took place over the end of the quarter. Is that correct, Stan? Yeah. So there was some money that was in Janice that got, and it was at the very end that we got the last of that money deposited or contributed to Mondrian. So that's where that came from.
But wouldn't that be sitting in cash then and come out of cash?
I think that cash account where it was didn't get picked up probably is what happened, or is it was in transit, so it didn't end up get picked up in the cash account, right? Isn't that what we're saying?
Yes.
yeah, that's the
Okay.
Sure.
Yep.
It should have been added into the cash account. Yeah, but it's yeah, we couldn't have had that new investment in that magnitude.
Right.
Any questions for Greg? All right, thank you, Greg.
Hi, guys.
Thank you, Elena.
Thank you.
See you. Yeah.
Okay, we have scheduled a break. Looks like Sherry,
I'm ready.
ready? Okay, let's take a 5-minute break. Be back here at 10 o'clock. regarding approval of annual cost of living adjustment COLA as of April 1, 2016.
Fine.
Dr. Wilbanks, take it away.
Thank you, Mr. Chairman. Trustees, you have in your board materials the memo from Callan Group regarding, or from Siegel Consulting regarding their recommended cost of living adjustment this year. Consistent with the board's decision last year, I would recommend the board approve the COLA recommended by the actuary.
Okay, any questions for Mr. Wilbanks? Mr. Judy, you have a question? Mr. Wilbanks?
Comment.
Okay.
Okay. So, you know, this is not popular for me to say this, but I'll still say it. The CPI, we have the ability to use the National Urban CPI as we discussed last year. And the National Urban CPI was available to the board back in 1974, and if the retirement board had, I believe 74 was the first year that the retirement board adopted a CPI. If the retirement board in 1974 had adopted the National Urban CPI, the CPI for the retirees, say someone who retired in 1974, would have been 3%, 2 out of 3 years, roughly, and 2.5%, which is the other increments, half for an increment, 1 out of 3 years. What we know is that because they adopted the Bay Area Urban CPI, the CPI for that same retiree retiring in 1974 was 3% every single year. They banked it in years where it was above that in the Bay Area. And they, I think today have a 3.5% banked CPI. So these are not radically different CPIs. I would actually argue that retiree in 1974 would probably have not even noticed the difference between the National Urban CPI, the same CPI that Social Security uses. The only difference is that our association caps it at 3% and then banks anything above 3%. The Social Security just allocates it all in that 1 year, and there's no banking. I would argue that because there is no rural CPI, there's only an urban CPI for the nation, an urban CPI for the Bay Area, that the national urban CPI is more closely tracking with Mendocino County. And so I think that is the more appropriate level to go with. Again, this is probably not, I'm sure it's not popular for me to say this, but I think it's the right thing to do. And so I'm not going to support the Bay Area urban CPI.
Okay. Mr. Wilbanks, can we use that rate, or I thought we were locked into either the urban San Francisco or the Western region, or but those are the two rates we're able to use? Is there
Memo I produced last year looked at the other 1937 Act counties, and of those counties that have a COLA as part of their plan documents, there are only 4 options of CPIs that are used by those 1937 Act counties. There's the San Diego CPIU, the San Diego area. There's the Los Angeles area CPIU. There's the San Francisco, San Jose Bay Area CPIU, and there is the Western Region CPIU, which consists of 8 states, including California, Oregon, Washington, Alaska, Hawaii, Nevada, Arizona, and Colorado. What's that?
Idaho.
Idaho. Okay.
Did you say New Mexico? It is. I didn't hear you say it.
Okay.
So the question is, when we voted last year, that's what I, that's
Sorry,
sorry.
Mr. Stevens, wait.
So those are the only 4 options currently used by 1937 Act plans. So when I did the research last year, that was what I put out in front of this board, is those are the options. I dismissed the San Diego and the LA as not being appropriate in my opinion. So that left us with the choice between the Bay Area and the Western states. And that's why I put that information in front of the board last year, apprising you that, and you have the memo, I included the memo from last year. There are a number of counties outside of the areas, the areas defined by the Bureau of Labor Statistics, that use the nearest local CPIU, and there are 2 counties that use the Western Region CPIU. Those are Fresno County and Imperial County. I don't have the list of counties outside of the defined urban areas that use the closest urban area, but there are quite a few of them that do so. What our choices are, could we use the CPIU for the United States as a whole? I don't know. In reviewing the issue, I went back and looked at when the decision was made in Fresno County to move from the San Francisco Bay Area CPIU to the Western States Region CPIU. There was a recommendation from the actuary and a letter written by their fiduciary council advising the board that that recommendation met 3 tests. Test 1 was, is it legal? Can you do this? And it clearly did. Test 2 was it a better indicator of inflation in Fresno County? And test 3 related to volatility of the index and whether contributions could end up being less volatile. I think test 3 is really not that important for us. I think test 1, this board has the authority to make the choice of what it feels is appropriate. Test 2 is where we have the issue. As you'll recall, last year, my memo said we should pick the index that best reflects the rate of inflation in Mendocino County. And that is the open question, and that is the open question to which we do not really have an answer. There is no data from BLS to which we can turn. I have talked to the Western Region Office of the Bureau of Labor Statistics. There is no data we can turn to. There is nothing. I've looked for some local experts that could give us some advice here, and have not found anyone that could come in and weigh in on this. I think we are at the point where we need someone to tell us this is the measure you should use because it most closely approximates the inflation rate in Mendocino County. And we don't have that at this time.
Jeff, what kind of due diligence would we need to do to be able to change the rate?
I think echoing the comments of the administrator, I think you need to have somebody, whether it's an economist or whoever, I don't know, provide information to this board so that you can say and satisfy your fiduciary duty to say, based on that information, I believe that this index is the best estimate of inflation in Mendocino County. I think that's what the test is.
Mr. Knudsen?
They had both their hands up earlier, I just beat this time, I want to comment when they're done.
Mr. Sackwitz?
Thank you, Mr. Chairman. So this is to legal counsel. Last year, the only retiree board members who voted against the higher COLA were Supervisor Jurdy, myself, and Trustee Stevens. And Supervisor Jurdy is correct in pointing out that it was unpopular. I had many county workers, including some I greatly respect, department heads and managers, come up to me afterwards and say, no, I wasn't Sharon, come up to me and say, you know, why did you vote for the lower COLA? You know, I thought you were pro-worker, and I thought, you know, in being a fiduciary, you always act in the best interest of the beneficiary. To which I replied, the solvency of the system is foremost in my mind. I have as my highest objective making sure that you get 100% of your retirement check, and that 100% of our retirees and 100% of our workers get 100% of what they expect in their retirement checks going forward. So anything I can do to be fiscally conservative, fiscally responsible, I'm going to do to build in those savings into our system so that I satisfy that highest fiduciary duty. So my question to legal counsel is that correct reasoning?
The board should not be guided by what's necessarily the highest return for the retirees. I mean, you have to meet your fiduciary duty test, and the SERL, the law that you're required to follow under 31870.1, says that you're supposed to look at the Bureau Labor Statistics CPI index for all urban consumers for the area in which the county seat is located. And so the Bay Area covers, I forget the number of counties, but it stops at Sonoma County. And then the next county over, of course, is us. So there is no clear answer. So that's where I say you have to be guided by the best information that you can obtain to know which is the best estimate of inflation in Mendocino County. And that's what you should be making your decision on. It shouldn't be, well, this doesn't have the best effect for the employees or retirees. It's, what is consistent with the intent of this code section, and that is to find the best estimate of inflation in Mendocino County.
Well, as you know, as we go further north from the Bay Area, the cost of living drops. So how do we drill down and focus in on what the cost of living is in this area? Do we ask our congressional office? Does
Can I respond?
yes?
Two issues. The cost of living is not what we're talking about. It is the inflation rate. The cost of living in Mendocino County is significantly lower than it is in the city of San Francisco. No question. The real question of what we're addressing here is what's the inflation rate? The cost of living in Mendocino County will always be lower than in the city of San Francisco as long as the city of San Francisco exists. But just because there's a actual difference between the cost of living in those two places does not mean that the inflation rate is higher or lower in one or the other. Okay, so I think that's a very important distinction that we have to keep in mind here. It's kind of a math geeking a little bit. So the level is not what we talk about. It's the rate of growth over time. That's the important thing for us to focus on here. The other issue is we don't know. We don't have data to tell us in Mendocino County the inflation rate acts more like this area versus that area. We don't have that right now. And we need some analysis to address that question. Ultimately is where we are. And I think Jeff and I are in agreement that we need to get some answers to those questions. We have been unable to come up with something to put before you and today to address that issue. I doubt we will be able to come up with something to put before you before next month. Because of that, I would propose that we continue with past practice this year. And in the fall, when we don't have numbers before us, when we have time to get research done and proposed to address this very specific question, bring the matter back before the board with the research, with expert advice, and a recommendation of this is what we should do. And my reasoning for saying continue with past practice is we do have past practice as a precedent there. It doesn't involve a change. And I have some concerns about making a policy change without a solid recommendation to do so. And I have concerns about protecting the board if that decision was made. So I think we need to get some detailed research and get an answer to the question. And there will be facets to the question to address. But I think we need some time, and it needs to be done thoroughly and properly. And not based on, I like the higher number or I like the lower number, based on the real heart of the question of what's the best measure for Mendocino County.
And as we heard from legal counsel, that's what we're mandated to do. That's what the shell says, go with the data that you're able to extract from your area. So if I were to make a motion, it would be to accept the actuary's recommendation with the understanding that we bring it back, when did you say?
Sometime in the fall.
Sometime in the fall, with economic data upon which we can make a more informed decision. So I would make that motion.
So we got a motion and a second. Okay, any discussion?
Jerry was first, in fairness to the rest.
Yeah. Ms. Harris?
I'm also, would have also been unpopular on this one because in looking at the inflation rate in the two hottest real estate and most expensive areas, not only in the state of California, but with the exception of New York City, in the country, we're comparing Mendocino County's inflation to San Francisco and Silicon Valley, basically. And that does not strike me as fiduciary as being the correct rate. So though I voted last time to go with the Bay Area because I felt that was the right thing to do at that point, I wouldn't do it this time. I would, however, support this motion so that we will have the proper information brought back to us as fiduciaries. No one should have to feel bad for voting in a fiscally responsible way.
Mr. Stevens?
Yeah, popular or unpopular doesn't make any difference to me. Following the law is paramount. And when I read it, my pride, and Jeff, I need your interpretation on this. How do I find, it says the consumer price index for all urban consumers for the area in which the county seat is situated. How is our county seat situated in San Francisco, Oakland, or San Jose? In the jurisdiction of that CPI. It's this county seat is not in that area.
That's true, but there is no absolute answer. And so I don't know how this board, how many years ago,
I disagree.
chose. That you're asking me, I'm giving you my opinion.
Okay, go ahead. But we're not, it says in that county seat, we're clearly not in that county seat, we must be in a different index. If we're not, it doesn't say you can choose which one. I've heard here we should choose which one best fits the inflation of the area, and we should have an economist tell us which best fits. It doesn't say that anywhere. Choose which one best fits. It says choose the county seat, and if it's the county seat is not in that index for those counties, it must be in another one, which would be the western region.
So that is an argument. I still think it's unclear that the western region is what the intent of this section was. And there are many systems that don't fit in with one of these within the Bay Area Index, and yet they have chosen the Bay Area Index. A couple have not. I still think it's a gray area. I hear the argument you're making, and I thought about that as well. I don't know what went into the decision making at the time that this previous board years ago said, well, we're just one county over. I still think at the end of the day, it's consistent with the board's fiduciary duty and consistent with this code section to get that information and figure out which one is more appropriate. And I don't think that at the end of the day, if there was some challenge in court, that a court would disagree with going through that process and making that determination.
Mr. Almeida?
Yeah, I'm a retiree from Mendocino County. In fact, I haven't been a retiree for almost a whole year yet. I've only received one COLA raise, but I paid into them for over 20 years, and I have tens of thousands of dollars that I paid in just to the COLA raises alone. If I never received another COLA raise, it would take me to the age of 87 just to get my own funds back out. So when you think about these decisions you make, think about the people who paid into these COLA raises. And I know Mr. Stevens told us last year that, oh, it's a shame the new people don't. I didn't vote for them not to pay into it, but I paid into it. I expect a match from the county. If the county, Mr. Jurdy, is so worried about this retirement fund, why are you paying 2 retirements to people who make 70 to 150,000 and above? By paying a 401k style 457 retirement in addition to a defined benefit. If this retirement is in that bad a shape, you ought to go to your board of supervisors and recommend changing that and putting all the funds into this retirement to save this retirement where the majority of the people are. In addition, when you look at the counties that are not in the Bay Area, which is only 2 counties in California, they are inland counties. They are not coastal counties. They do not have the cost of living or the CPI index that justifies being in the Bay Area. They are in central and southern California inland. They don't have the prices that we have. And while fuel is down right now, it is not down as much as it is in the Sacramento area, and definitely not in the United States or Western states. Well, they're having a fuel war in Michigan at 47 cents a gallon. We're right at about $2.13 a gallon average in Mendocino County. All of your prices are up. Go buy a battery for a car at Walmart. The cheapest place you could go is over $100. Never used to be that high. Anything you go to buy, my vehicle, my newest vehicle is 12 years old. Anything you go to buy, the people in the lower areas of this retirement, which I am, they depend on these COLA raises. They don't want to change to something else because they depend on these. These prices go up. We know that fuel prices are going to go back up. PG&E just raised their rates 8.5%, if you've read that in the newspaper. Food prices continually go up. Everything is going up. This county had one board member of the Board of Supervisors that sat on the Golden Gate District. So they must have something to do with the Bay Area. This high school plays in a North Bay League. I think we're pretty well connected to the Bay Area here. We might not have the inflationary rate that Silicon Valley has, but we're having it go up. So I don't feel guilty about wanting the COLA raises that I've paid into. And I don't feel like I should have to live to 87 years of age just to get my own money back out. If I didn't pay for 2 deductions like people on Social Security, and I know that's where Mr. Jurdy would like to go, they don't pay in for a COLA raise. So when they get a COLA raise, they just happen to get a COLA raise because the government decides they need it. But we paid into these COLA raises. And it's very serious to me and other people that are retired that receive them. If there was a cap at $50,000 for retirees, that you couldn't make over $50,000, it would be fine with me. But you see, I don't even come close to that. So the COLA raises are very important to me. And as a fiduciary of this board, I expect you to respect that and think about the people who have paid 2 deductions. They paid 2 deductions into this retirement, and they deserve to have those raises. And I'm tired of seeing this going to a western states with somebody that lives in Wyoming that has their own oil wells are quite a bit different prices than what we're paying here, even though the prices are lower. We don't live in Idaho, we don't live in Wyoming, we live close to the Bay Area. A lot of our money goes to Sonoma County, just because this county is not keeping up with what they ought to be keeping up with. You see tax dollars going right out of here. And the people who make these big retirements, they're not buying Chevrolets, they're buying Mercedes and BMWs, and you don't see a dealer here in Mendocino County for that. Think about that. When you make these decisions, people that live, that struggle on what they make when they retire, deserve these raises.
Thank you, Mr. Almeida.
Yeah, I won't go over what John
Mr.
went over. I agreed with it, it was part of what I was gonna say, but I'm remembering last year when we discussed it, James, you were fairly new here, and you contacted the previous interim retirement administrator and said, asked him what he thought about it, and he said he's always heard from the actuaries, you pick one and you stick with it. You don't jump back and forth picking the best one. Now, this year, you should know, the actuaries are recommending a 3% COLA. The Western region is 2%, correct? Next year, the Western region could be higher. Are we gonna go back to the Bay Area because its Western region is higher and we wanna pick the lowest one? I don't think that's how we best serve our customers. And I want to remind the board that during our strategic planning meeting, we determined who our customers were. And it's people like John, it's retirees, and it's the employees. And if we don't do what's in their best interest, we're violating our fiduciary responsibility. And John, you can't say that I'm concerned about the overall livelihood of this thing. That's betting on, that's in being in Vegas and betting on the come line, or however you do that in craps. I don't even know how to do it. You're betting on something you don't know is gonna happen. This is something we know that's gonna happen. People such as John are gonna be hurting if we don't give them the COLA that they're used to. The actuary, you mentioned that Fresno decided what to do on the recommendation of their actuaries. Our actuaries have recommended that we stay in the Bay Area. And I think that's only fair thing to do at this time. If we wanna look at it down the line, I think we ought to have our actuaries involved in it. And if you don't think it's expensive to live here, next time you're gonna go down 101, drive by the Shell station and the Chevron station and take a look at their prices, and then go down to the Bay Area and look at their prices. Almost identical.
I have a question on.
Hold on.
What
Ms.
Tim
Shatmeyer,
said.
hold on. Ms. Shatmeyer? Did you have,
Yeah, well, I have a statement.
Yeah, I'm finished.
Yeah.
I have a question to clarify for what Tim
oh,
said.
okay, you have a question for
Yeah,
Tim?
for
Okay,
Tim.
point of
Where
question,
did they
okay.
recommend that we use the Sanford, they said, consistent with the procedures approved by the board? They haven't recommended it. They're following our lead, what we did last year. So they're not recommending to us. Did we do that?
I'd read that as saying consistent with procedures approved on their, if it's not a recommendation, I don't know what it is, that we use the Bay Area CPI.
Okay. Ms. Shatmeyer?
So, first of all, today, I wouldn't be comfortable voting for anything other than this unless we postponed it to next month and had another, something like this to vote on, for one thing. That's just one issue. The other thing is I really do appreciate Supervisor Jurdy bringing this forward. This was something that was decided in 1971. I do appreciate having a review. I mean, it blew me out of the water when he brought it up last year. I didn't even dawn on me that there was, I never had even looked at that. So I think it's a reasonable thing to look at. But that being said, I don't really feel like we should jump unless it's the right one to jump to. One of the things I thought of, and I don't know if this may be totally out of left field, I mean, I don't know if it's 100% one CPI, or is it 50-50, whatever, using two and averaging them or whatever. I mean, I think there's all sorts of things we can look at to make this the most correct that it can possibly be. And I agree with one thing Tim said too. If we do this, in no way, shape, or form do I want to be looking at this every year or two and switching it to higher or lower. I don't want to go there. What I'd like to do is, if we do jump, and I don't know if possibly now that this has been brought up, maybe we do need a policy, and maybe from the time we make a change, maybe we need to look at it every 5 years or 3 years or whatever we determine. But I just feel like I'm not saying it's out of the question to switch one way or the other, and it's not that we're going to be taking anybody's COLA away. It's just giving them the most accurate COLA that they should be getting. And I just think if we have the time, I really do think it's an issue that we do need to look at. But I think before we jump, there is definitely a precedence out there for 45 years, according to this, that we've taken this one COLA. I mean, for us to switch, to do a total switch to something else, we do need to have data to prove that we did that. We did our fiduciary duty, and we did it because here's the data that supported that.
And that's what the motion is. The motion is to accept what's here and bring it back in the fall to really look at it and dig and get some more expert advice on what COLA.
And I absolutely support that motion.
All right. Mr. Wilbanks, did you have something?
Trying to remember, Tim said something that I thought I needed to point to.
Pretty short.
I made it.
It has
You want me to
a
repeat myself?
That's good.
All right, so we have a motion and a second. Any more discussion?
Just that I'll support the motion.
Okay, all right. Judy, you want to do a roll call on the motion? We have, the motion is to accept the COLA as it is with the understanding that that it's gonna come back in the fall,
That we will bring the issue of which measure to
in
use.
the fall with a lot more information that we can make
Based on economic data.
an informed decision in line with our fiduciary responsibility. Okay, Judy, roll call, please.
Ms. Schnattmeyer,
Yes.
Ms. Cavnis,
Yes.
Mr. Sakowitz.
Yes.
Supervisor Jordy.
Yes.
Mr. Stevens.
Yes.
Mr. Knutson.
Yes. I'm reeling over Ted.
Did you hear
I
him?
didn't hear
He
you.
said he's reeling over your boat.
I lost track of what.
Ms. Harris
Thank you.
Yes.
and Mr. Goodman.
Yes,
Approved.
okay, unanimous, it's approved. Okay.
A point of information, Mr.
Yes,
Chairman.
yes, Mr. Sakowitz.
When was the last time we had a unanimous,
Well,
It's
now,
been a while.
well, and that was an important issue. I mean, I think everybody needs to pat themselves on the head with this. I think this was a
That was
nice
a great thing to
consensus.
do.
James,
This
Yes.
went,
You
a
approved
lot
the
more-
minutes unanimously.
this went a lot more
Just
smoothly.
a little earlier today.
Oh, okay.
The actuaries involved
Okay.
with that, you were gonna think of-
Let's move on. Item number 6, discussion and possible action regarding retirement administrator evaluation policy and evaluation form. Okay, that would be number 6. Remember we had that last month and we brought it back to add the criteria, and I'll turn it over to Dr. Eubanks. Well, Banks?
Whatever your name is.
I got alphabet promoted. Thank you, Mr. Chairman, trustees. You have this before you, and based on the conversation and the direction last month, the categories were added back in here, so that any year that there's anytime that the board feels there needs to be a change to the categories on the evaluation form, we will have to change the policy. But you have that policy there with categories, and also the proposed evaluation form attached. I did get one question from the chairman about on the form, the overall performance, bottom line. I'll make a slight edit to that to indicate that it is not something that is calculated based on, your trustees' individual evaluation up above. It'll be something that the trustees are expected to give an overall evaluation there as well. I'd recommend approval of the policy and the form, and happy to answer questions if there are any.
Any questions?
Just one quick one. Oh,
Raise your hand, and I think Mr. Stevens was in front of you, though.
You let him go.
Okay, go ahead.
It's just real quick. Is the red line from the original policy or from what was presented last month?
It is from the original policy.
Okay, that's all.
Mr. Stevens.
So, why do we have the change in disclosure? So, before it was confidential until released to the board, before it was, now it seems like this will all stay in closed session. Before it was confidential during the process, but was open afterwards. Why that change?
It's a personnel matter.
Personnel matter, there would be no public discussion of.
Why do we have it before the way it was?
What, we didn't ever bring it to the public. I mean,
The report out would only be the evaluation was given.
Yeah, I mean,
That'd be the only public information in the evaluation process.
yeah, the two previous ones that we've done, we shared it with, I shared it
Wasn't
with
this a
them, but not
previous
with,
policy?
I don't know what the.
We're redlined over, and I heard it was a previous policy that we had adopted, and we redlined over. We had a policy before that was not consistent with what labor law was.
Where's the change you're referring to?
Page 2, the chair will ensure that all data is calculated and summarized and treated as confidential until released to the board. Is number 5, and number 6, the evaluation process itself will be conducted in executive session, now it says closed
The
session.
the executive and closed, they're synonymous, and being released to the board
Okay, the
just
last
means
one.
that the board members get it, not that the public gets it.
And
Right,
it was
so-
always done in closed session. I think.
So I
Before
took-
the retirement administrator will join the board in closed session inserted, where before it wasn't, for review and discussion. Why all those changes to closed session? If, I think I was told it's the labor law, but were we outside of labor law
It's
before?
not the
with our
labor law,
prior
it's the Brown
policy?
Act.
We were outside of the Brown Act before?
No, it's just clarifying. I would have read those words into it had they not been there. Will join the board in closed session.
I think it's
So
just,
that's what was happening, whether those words were in there or not, that's what was
Does that
happening. I
need to be
believe,
in
and
closed
that's what
session?
should be happening. It's,
Yes.
yes.
It's required?
Well, the Brown Act permits it to be held in closed session, and the constitutional right to privacy confirms it and allows it.
Okay. And all data tabulated and summarized is for this kind of review is always in government bodies confidential? It's not released?
Correct.
So that should have been there before? That was a mistake until released to the board?
I don't know if it was a mistake.
And that's talking about
Well,
the
you
chair.
just told me it's illegal to release it.
Yeah.
Yeah, go ahead, Mr.
The intent here, when I saw this, was to clarify that this is a personnel evaluation, and it is not something that is typically done in full view of the public. And I wanted to be very clear here that this is something that is conducted between employer and employee and is not part of the public discussion.
As a fiduciary and trustee on this board, my question is the policy we have before, was it not within the legal, normal legal boundaries?
It was within the legal boundary. There's no legal issues here. I mean, it's just clarifying language. It's very common for all boards to review department heads and managers in closed session, and there's nothing that's public information about it.
Mr. Jurdy.
So just as a point of reference, so the Board of Supervisors will do an annual review of the CEO, and that review is her, it's her personnel file. And but if a member of the public wanted to look at what the blank form looked like, I believe that's a public document.
That's in the policy.
So they couldn't go through public records and ask to see what her performance review was.
I don't
They could see
believe so.
the-
I think like
They
any
could
others-
ask for it,
Yeah.
but they're not entitled to get it.
I believe
They
unless
wouldn't get it.
I believe unless the public employee wants to release it, it's confidential.
Correct.
Okay,
But the employee could get it, and then the employee could
Mr.
release it.
Stevens, the
I'm just trying to understand the rule.
Do you need a motion to accept this?
well, you have a point and you have a question, okay.
The answer to thank you.
All right, do we have a motion on the table?
Yes, motion to accept the evaluation policy and form as presented.
Second.
Okay, we have a motion and a second on approving the retirement administrator evaluation policy and form. Any discussion, any further discussion? Okay, all those in favor say aye.
Aye.
All those opposed, say nay. Okay, that's approved, unanimous. Okay, number 8, discussion and possible action regarding State Association of County Retirement Systems Sackers Voting Authority Policy. Okay, this is a new policy that Dr. Wilbanks is bringing before us. Dr.
Did we
Wilbanks?
skip over public purpose policy?
Oh, did I? Oh, I'm sorry. Oh, I'm sorry. I scratched out the wrong one. Okay, I'm sorry. Number 7, discussion and possible action regarding draft public records policy. Okay, this again is a new policy that Dr. Wilbanks is bringing before us. Okay, Dr. Wilbanks?
Thank you, Mr. Chairman. Trustees, you have a new policy here related to public records. We have no existing policy as to what we treat as a public record on our retirees and what we do, and members, and what we treat as a private or confidential record. This policy outlines clearly what we do, what is considered public and what is considered private and confidential. The advantage of adopting this policy is With a policy in place, I don't have to call Jeff every time I get a call from the press saying, I want this piece of information. I can use policy as a basis for responding in a more timely manner to the records request, whether it be press or some other member of the public. This policy was drafted looking to public record policy of Sonoma County, who has done a lot of work on the public records issue, involved in a court case there, and they know a lot about it, so we benefited from their experience.
Any questions for Mr. Wilbanks? Ms. Harris?
No,
Oh.
Go ahead.
Mr. Stevens?
Well, I was gonna make a motion, so, you know,
Oh.
if you have a question.
Yeah, so policy guidelines, 2C, I want an example of where the public interest is, where provided that, so we can withhold, provided that the public interest in withholding those records clearly outweighs the public interest in disclosure. Who are we to make that decision?
I would look to legal counsel for
That's
guidance.
just the framework that the Public Records Act operates under.
So we have a policy where we're saying we're gonna hold our preliminary drafts, notes, interagency or intra-agency memoranda that are not retained by Macera in the ordinary course of business, provided that the public interest in withholding these records clearly outweighs the public interest in disclosure.
From a practical standpoint, I don't think you have, I mean, you may have some rare situations where you have preliminary drafts and notes, but it is more common in other public agencies, not necessarily retirement associations. But there's a lot of practice around public agencies to destroy drafts and notes. There's other privileges that may apply to a Public Records Act request, like the deliberative process privilege. We're getting a little bit into the weeds. I really don't think there's a lot of significance to that particular section, but it is absolutely consistent with interpretation of the Public Records Act.
If I may, Mr. Chairman. Ted, to your point, I do have a history with using a similar protection. At some point during my career, I worked in the office that did bill analysis for the governor, for bills that hit the governor's desk. And all of that work was a draft that was protected so that the analysts could, it was not the governor's office, it was a separate office, but we were doing that work for the governor. So it was all a draft so that it was protected, so that we could thoroughly vet the issue and put a lot of things in that analysis that the public wouldn't necessarily see, so that the deciding body could have all of the information. So that's an example, doesn't necessarily apply here, but that's where that exception, I'm familiar with that.
So my real question here, is this drafted with intention of not disclosing any information where we've previously disclosed it?
Absolutely not.
Okay.
Absolutely not.
Thank you.
The intent here is to share with the public, this is what is public information, and if you ask for things on this list, we will get it to you in very short order.
Because we don't have to go through the
Because we don't have to go through legal counsel. Also, here's the list of things that we will not share with you, period. Unless you are the member or the member's authorized representative. So,
Ms. Harris?
I move that we approve the public records policy as presented.
A second.
Okay, we have a motion and a second to approve the public records policy. All in favor, say aye.
Aye.
All those opposed? Okay, pass unanimous. Okay, now number 8, discussion of possible action regarding State Association of County Retirement System Stackers Voting Authority Policy. All right, turn that over to you again, Dr. Wilbur.
thank you, Mr. Chairman. Trustees, you have the policy proposals in red line form there. This is due for review. Overdue, slightly overdue for review. The changes here are largely cosmetic, formatting issues. Would recommend approving.
I'll move to approve.
Okay,
I'll
have a
second.
motion to approve, a second. Okay, we have a motion and a second to approve the policy regarding State Association of County Retirement Systems, SACR's voting authority policy. All those in favor, say aye.
Aye.
Any opposed? Okay, passed unanimous. Okay, number 9. Discussion of possible action regarding trustee education and travel policy. This is an existing policy that's up for review. Just Dr. Wilbanks.
Thank you, Mr. Trustee, Mr. Chairman, trustees. You have the proposed red line document before you. The policy is overdue for review. There are some changes in here that are formatting issues by and large, clarifying the intent of the objectives of this policy, and also eliminating specific mentions of targeted conferences and meetings, training events provided by SACs and CalPERS, and then changing, instead of listing Callan Associates as investment consultant conferences, changing that to investment consultant conferences inside the state of California, and keeping with the county's policy banning out-of-state travel currently. So if we ever get rid of Callan, we would not necessarily have to change this policy as a result of that.
Any questions for Mr. Stevens?
Would this red line change anything we're doing now? Is there any policy change you see that we'd have as a result of this?
I do not see any change.
Thank you.
Any other questions? Have a motion?
I'll make a motion to approve it.
Second.
Okay, we have a motion and a second to approve the trustee education and travel policy. All those in favor, say aye.
Aye.
Any opposed? Okay, passed unanimous. Okay, number 10, discussion regarding 2016 board training plan. Dr. Wilbanks?
Thank you, Mr. Chairman, trustees. In reviewing the trustee travel and education policy, it became apparent to me that we have some training that needs to be provided to the board. And there was discussion, I'll remind you, at the offsite of getting some in-house training opportunities. So you will see there that in February I had investment training on asset categories. We actually didn't do asset categories today. We did capital markets overview instead. At some point we will come back and talk about asset categories with Callan as part of the asset allocation study process. We are also required by our trustee education and travel policy that the board is, and by Assembly Bill 1825, the board is required to receive every 2 years sexual harassment prevention training and ethics training. We have those tentatively scheduled for March and April. Those may get moved around, but I wanted to put this before you for discussion. This is not something that I think the board has to approve unless you want to. Well, you can't today. But this is what I'm looking at and thinking of in terms of our board meetings for the rest of the year. I do have every quarterly meeting where the investment consultant would be here, I think is a good opportunity for us to have something specifically from them. But there are other issues, and I did leave some months. June, I believe, I left open for the retirement administrator evaluation. I know we just reviewed that policy. I think that starts in May.
May goes, the packets will go out in May.
And then we do the evaluation in June? Is that?
Yep.
Okay, so, and then Brown Act in December. The thinking there is there could be some change in the composition of the board, so Brown, that would be a good time to come back to the Brown Act.
Shopmeyer?
I like this a lot. So the county does trainings too, and we're gonna do, but we'll do them here instead. I mean, because I would think that this board could also participate in the county-led, especially on the sexual harassment and the
We also have
ethics.
the ethics one too, I think.
Yeah, and maybe the
Okay.
Brown Act, I think. I mean, there's a couple, but I do agree, the Brown Act's nice coming from Jeff.
My
So-
sexual harassment training is probably way better.
Way better, way better? I bet it is. But anyway, I was just, I mean, that is, but it is nice, I think, to look at it from this perspective. But we do have that opportunity at the county as well.
Okay.
so.
The tentative plan was for our legal counsel to cover the sexual harassment prevention and the ethics specifically with this board.
Well, actually, I wasn't planning on covering the AB 1234. That's really not an area of expertise that I have.
Oh, that's
Our
right.
office has developed a DVD, and maybe it comes right from the FPPC, the Fair Political Practices Commission.
Yeah, they have it online.
And so that's,
Then
that-
Okay.
Saturn does one too, like a.
Oh, that's true.
They do one
They
on like
do.
the very first day,
Right.
they do a ethics training.
Just a quick question, is Judy tracking, you have to do that every number of years, we have to do it every number of years, you do tracking?
I think, yeah, some of these are every 2 years, like, I think the ethics is every 2 years, sexual harassment may be every year or
Every 2 years.
Every 2 years, okay.
Okay. All right, any?
You have questions? So fiduciary duty, we covered that in January?
Callan covered it during their training. It was also covered during the strategic planning offsite, the first day. We hit it a lot, and I think it's important. Yeah, that was included, Callan included fiduciary duty in their training that they conducted.
If we piggybacked on the county's program rather than had Jeff develop these programs for us, what kind of cost savings would it be to the association? Has anybody calculated that?
there's no development of it. I mean, I do the training for the county employees. and
So you don't
I've
have
got
to make it, it would just be your
I've done
time
it,
here.
Yeah, it's just time.
Which he would be here during a meeting if we were receiving training anyway. So,
Are you,
Absolutely.
Just to
quickly,
repeat.
are you developing the training and developing how, the first question is, do we get credit for our training, the 24 hours that we need to do every 2 years for any or all of these?
Some of these we will definitely get training credit for. So the Callan event last month, everyone that was there got the credit for that, for sure. When we do the sexual harassment prevention, you'll absolutely get credit for that. The ethics, the same thing. The investments can get a little squishy, but we'll think about exactly how we want to do that, and does it really meet the test of this was a training thing or was it a providing of information event? So anything that we are specifically designing as training, we will make sure that all the trustees present get credit for.
Any more questions? Okay. Monthly financial report. Michael Wilbanks.
Thank you, Mr. Chairman. Trustees, you have the report there. I am happy to call on Stan to answer any questions you may have.
Any questions?
Can we push a button and know what our value is on our portfolio now?
I had that question too, on the custodial bank.
Stan, can you give us an update on that?
On the custodial bank,
Yes.
Currently, right now, we have December's numbers in there. I just talked to our relationship manager this morning, and I haven't had a tour of the site yet, so I need to get trained on the site, so I can see exactly what we can have, but that's gonna be the eventual goal. People log on and see the prices from the previous day.
Everything valued as of the previous day.
everything that can be priced, the previous
So
day.
with you, and then we'll load in our real estate like here and that'll be on that system too? Or will you add that in separately later?
I think some of the real estate gets priced daily. Some of the Cornerstone does not.
The REITs get priced daily.
What was that?
REITs get priced daily.
Uh-huh. But so
Like
like something in
Cornerstone
this
is-
building and some of our other real estate that's not priced, are we gonna load it on their system?
I
Or
think-
are we gonna, is it gonna be, when it's not refreshed? Or is it going to, are we gonna have to add that back in?
I think, see about Callan should add that into their report. It's not really that's not really part of what our,
Callan does have their stuff.
yeah, so I mean, that's what I do, is like, I have some stuff outside of my
That
third
you
party
give it to
vendor.
them and custodial bank has it?
Basically, they know that, like, I'll either give them, yeah, it's the.
And it stays the same until you update it?
Well, what happens, that was gonna be my question, is like, for me, I get a monthly report, so like, usually one or two, probably like the second day into the month, I get a report, and I didn't know if Stan got, I was curious if Stan got, if he's actually, like, I don't really feel any need to go in all the time, because I get a report once a month, I'm the only one really looking at it.
Anything
And
I
yeah.
have, we should be able to push a button, and we should be able
Right
to see
away.
it within so many hours after the market closes, normally is what the standard would be. My concern, and I'm sure this will do that, but my question is, what do we do with our items? What are we gonna do with our cash items? What are we gonna do with our real estates that aren't publicly traded, so we don't have that? And what are we gonna do with this
Yeah,
building?
so
I'm just
for me,
wondering.
You're
Yeah.
gonna carry them at the last
I
price that you
understand.
had.
Yeah.
I understand what the value is until we get an update on that value, but is it gonna be on their paper? Or are we gonna take their paper and add those to come up with our value? So if he pushed a button this morning
I don't think
and
so.
brought that in and said, here's what it was at yesterday's close for you trustees, this is what we have in the market, is he gonna have to put that in a spreadsheet where he has these other ones? Or are they gonna carry it on their system so we can see the total number?
I don't recall the answer to that, Stan, do you remember?
I think it'll be loaded, the price, for example, the real estate, the Cornerstone, that'll be loaded as of the last quarter, the price would be. So,
How about King's Court? That's even, I mean,
yeah,
I use that as an
that's
example.
on there too.
It is on their report.
Yeah, as,
The last valuation we gave them.
yeah, exactly.
You'd probably have to add in our cash, because that changes every day. They're
Yeah,
not, gonna- like you do on your report now.
yeah, because we have cash at the county,
Right.
so,
So I'll have everything but cash at the county.
yeah.
Okay.
in this
Thank you.
building, or they do the
The
oldest
building
in this
will be on
building.
Yeah.
Okay.
Yeah, that's what I do, I mean, for mine.
Okay, any more questions on the financial report or the
Yeah.
custodial bank?
So are we gonna get, in the future, since we have this capability, are we to get this report and just a snapshot of what the latest day is too? Or since we have that capability, or what are you gonna do? What are you gonna give us?
My thinking is month end instead of daily, because it changes so much, month end. And there is the process with a custodian of, they go through a final reconciliation. So you can get a snapshot at end of previous day, but then at month end, there is a reconciliation process that they go through. And that's what I would be much more comfortable sharing with trustees, is a month end reconciled statement.
How long
And
after
that's
the
where
month
we're-
end do they do the reconciling?
It's,
Should be quick.
is
Has to be
it
days. A couple days.
5 to 8 days?
Somewhere in
So that'd be something that we could have at the meeting.
Yep.
Yes.
We should always
yes.
have the end of the prior month.
That's what I
Yes.
think.
Yep.
Right.
Same here, yep.
That's one of the advantages of getting the custodian is we have daily reporting and then we have month-end reconciled reporting that we can put before the board. Because currently, the monthly investment report you're looking at now was from close of December. So we'll move that up a month once the custodian gets everything in, loaded, and we're ready to go.
Nice. Okay, any more questions on the monthly financial? Okay, quarterly budget update. Dr. Obeck?
Thank you, Mr. Chairman. Trustees, you have the quarterly budget update before you. I will confess, we did find one minor typo on page 6 of the report.
Page what?
Page 6, the
Are they
last
numbered?
page.
Are they numbers or nothing?
No, they're not numbered. The last page of the report. The second line of the header should read fiscal year 2016 budget comparison. And then the first column should state FY 2016 July to December budget. So chart 1A and 1B are current quarter versus prior year quarter, and current year to date versus prior year to date. Chart 2A and 2B are current quarter versus budget, and current year to date versus budget. So the analysis is there before you. Fiscal year 2016 spending overall, we are below prior year. Year to date, in total by, get to the right page, 5.95%. If you look at the administrative expenses solely, we are 4.8% below prior year to date. Compared to the budget, we are 17% below in total and 14.4% below budget on administrative expenses. We are expecting some expenses to pick up in the back half of the year.
Ms. Shetler?
I just, on the audit, is that higher? I just know there was, you know, a lot of difference there on the audit. Is that because of the new reporting requirements? Is that why those, it seems like there was just a.
You mean on their fees?
Yeah, it just seemed like there was a lot.
It should just be what was contracted.
I'm just, in comparison to last year, in comparison to the year before, seems like I just.
12 grand more?
Yeah,
Yeah,
I just noticed there was a big difference in.
Did we renew a contract? I think it was for a higher amount, but Stan?
Well, the difference isn't due to timing. They sent us their bill earlier this year.
So there's a timing issue there?
Yeah.
Because we got done
Yeah,
earlier?
Yeah, it's under contract, so they can't go over that amount.
Okay, you guys are checking that against contract?
Yeah.
Yes. You'll recall that last year we didn't finish the audit until February. And this year we completed it in January.
I have a question for you, Stan. On the last page, we're showing, it looks like we're 17% under budget. Is that gonna be a permanent difference, the 169, or we expected that to change a little bit by the end of the year? There's some expenses out there that haven't been picked up yet, or?
There are some expenses. If disabilities could pick up, and that could make that percentage go down. But a lot of them, like an investment expense, I had to put in some estimates because we didn't have the bills as the time for this report. So actuary expense, I put an estimate in there, but that could go up a little bit. I think the monitoring could go up a little bit. But if the trend continues, we should still be under budget or at budget on the whole by the end of the year.
Question?
Mr. Sakowitz.
Thank you, Mr. Chair. I know from following Board of Supervisor meetings that that with the with basically the solution of Mendocino Public Access TV, the county is now stepping up. It has its YouTube channel now, and is making other in-house. Their IT department is making other in-house accommodations to pick up the broadcasting of meetings. Does that relate to our community access budget line? And if so, how are we going to adapt to the change in the broadcast of our meetings?
We are adapting, as you are aware. In terms of the budget, what that will look like is, I do believe that community access is was the Mendocino access item. Is that correct, Stan?
Yeah.
Yes.
Okay. So what you will see in the future is that line item will probably go away, and there will be something of an increase somewhere else, and we have, I'm not recalling where it is, but we pay the county for IT support.
Right,
So we would expect to see an increase in costs on that line item in the future.
right, without any interruption of the broadcast of our meeting.
Correct, correct. And actually the county is talking about making improvements in terms of the access and the broadcasting.
Thank you, sir.
Mr. Stevens?
Stan, where's custodial bank on our investment expense?
It's not on this report, but as soon as we get a bill,
Did it say again?
as soon as, we haven't gotten a bill. from them
Okay,
yet,
so they just haven't billed us.
Yeah.
It will be in the other?
Yeah, I'll add it on.
Thank you.
Just for clarif,
Oh.
so for clarification, I think you said this at the very beginning, is that where right now it says fiscal year 2016, it would be 15-16?
Not on that page at the end, that last page.
Yeah, the very last page, it says 15
In
up at the
comparison.
top.
Year-to-date budget to year-to-date actual.
Yeah, but wouldn't each of these columns also say 15-16? I mean, there is,
No, because okay, if you look at the first line of the title of each schedule, or, I'm sorry,
I think
the
you said,
third line.
should that say FY 16? So you're comparing this as an FY.
Yeah, the last page, every FY on the last page should be fiscal year 2016. Because that's a budget to actual comparison.
16, that would be 16.
So,
Yeah, the
See-
first ones are fiscal year comparison, so it was 15 to 16. It's just on the last one where they have the
Comparing current
budget, it's supposed, budget to actual is both 16. So that's the only correction.
Any other questions? All right, retirement administrator's report. Dr. Wilbanks.
thank you, Mr. Chairman. Trustees, you have the report before you. You do have the pension administration system update from our project management consultant. We made it through January, got checks cut. We had just a couple of minor issues that we identified in the process that we're working on correcting. And things are moving along. We are continuing to just chop wood on implementing the project. We're also, we have tentatively planned to start the electronic document management implementation in April or May. So that process will begin soon. We wanted to get through the implementation period first with Pension Gold, and then start thinking about moving into the imaging. The client presentation that you have included there, consistent with what we discussed at the offsite and as included on the 2016 work plan, was pushing out information to clients. I wanted to share this with you so that you would see exactly what I'm putting before the clients. And this is targeted towards active employees. I have a different presentation that's more targeted towards retirees that's not quite finished yet, but that's something that will be coming. I've done this presentation twice already, and we'll continue to push it out to more work groups.
I just wanted to point out that, that on the pension math page, on page 2 of the PowerPoint slide, it's showing the county's employer contribution to MSERA in that year, and then the employee contribution, but it doesn't reflect the county's contribution towards the pension obligation bonds, which effectively is going to MSERA also, and the county is moving ahead with transparency to the employees about how much the employees and the employer are contributing towards the pension plan, which will be an addendum PDF to the pay stub, and it will show the pension obligation costs. So I'm just pointing out there's going to be a discrepancy between what this is showing to the employees and what the county is showing, because the county's going to include the pension obligation bond contribution, which would be another $8 or so million on top of the 15 from the county. So I'm just pointing out there's going to be an inconsistency in what they're going to see.
having spent a lot of time in the classroom, you have to think about your target audience very carefully. And you need to target the message to that audience. And you have to be careful because you can overwhelm people very, very quickly.
You also can't go to our, if you put that directly in here, it should be footnoted with an asterisk maybe, and then it will coincide with what they see on their paychecks. But if you put it in here and dropped it in here, you couldn't go to your actuarial evaluation report or audit report and reconcile it. So I agree with you, it is part of the expense and the employee should see it because it's total part, but it should be in there in a footnote. I have questions on the pension math too when I can speak to them.
Okay. Mr. Sackwitz.
Thank you, Mr. Chairman.
Mr. Stevens.
Dr. Wilbanks, can you say a word, please, about the warranty period for Pension Gold?
The warranty period
Yeah.
or the,
I know we discontinue our old system, and there's a warranty period, isn't there?
there is there's a different word, what's the word I'm looking for? The service period or the
The support?
support period, that's it.
Okay.
There's a 3-month support period after go live where we still have dedicated focused time and attention from the group that was programming and implementing Pension Gold for us. And that will run into April. The warranty period, if you will, to my mind, is somewhat never-ending because they're always there. They're hosting our system. They host our data. If we have issues that come up, we go to Pension Gold and we get them fixed. So I'm not sure exactly if I'm answering your question. This is not going with a solution like Pension Gold is not something you get implemented, you write a check, and then you walk away from the vendor. You are with this vendor for a very long time. And that's the way I think it should be. I think it's the best solution, especially for a group like Mendocino County Employees Retirement Association.
You answered my question, thank you.
Okay.
Okay. Any more questions?
Yeah,
Mr. Stevens.
So on slide number 4 and slide number 8, I have questions. So realize that who your target audience is. Realize you certainly don't want to put undue concern on any employee. But when I see a strong statement is my benefit secure, and absolutely exclamation mark on page 2, slide number 4 of the presentation for Andrew. A lot of financial minds inside the county and us outside the county feel that's an inaccurate statement. We're very uncomfortable with that. When we look at this system, we say it's not sustainable. When I look at number 8, and I see, it'll go 39 years. If I extrapolated what it was 5 years ago, 10 years ago, and draw that line out, it won't go 39 years. It'll run out really quick. So, and I'm not saying it will. I'm not saying that right now we have an immediate crisis, but I am very concerned, obviously, about the welfare of this plan and being able to pay benefits that we promised to the county. My fear is that we're setting up a false sense of security. So should you say that there are people that are seriously concerned about this plan? No, I don't think you should say that. But when you say that, when someone says, is this secure? And we've looked at the financial degradation, those of us in the financial industry, and I know we're gonna have differences of opinion on this, but people with a strong financial background, they say that is a reckless statement. So my question for you, is there any other way you could serve our clients and not put undue concern on them, because I don't think we want them to be concerned, and I realize that this is something we're all working on and are very sincere about trying to solve. But is there any other language we could use there, and is also the same kind of false sense of security that's given that it would be 39.3 years before this plan wouldn't be able to pay benefits.
So I think the best possible outcome would be for you to come and hear the presentation as I give it, because there are statements here, but there's a lot of information around these statements. You know, the people that are listening, that are targets for this retirement, have this very real question, okay? And is my benefit secure? There's a lot of talk currently amongst county employees that because of these so-called financial experts screaming that the sky is falling, which we all agreed was not the case at our offsite. There are people concerned that they need to come and draw their money out right now because this thing's about to crash. And what I am trying to share with our clients is we're not about to crash. Do we have problems? Absolutely. We need to continue to work on those problems, but it's not falling apart right now, okay? And that's what I'm sharing with the clients. I'm not saying everything is rosy, okay? I do point to the pension math, that the county is contributing a lot of money to this system, and that is an issue. It's not shown here in the slides. There's not a bullet that says that, but I point that out as...
No, I saw your slide. Your slide did a good job of showing counties contributing a lot of money, and it's still not enough. We have to sell a bunch of assets to make benefit payroll. So you do show that.
I think it's also important that, you know, I included on slide 9, our projected UAL. That's a graphic of our amortization schedule. That this is not something that goes away overnight. It takes a long time. I talk through in the presentation, depending on the group that is hearing this, how you solve an unfunded liability. There are only 2 levers. It's time and money, and it's that simple. You can reduce the amount of time, but it takes more money. You can reduce the amount of money, but it takes more time. And how the county and this organization has taken steps to reduce the amount of time, and how that is a good thing for the longevity of this trust. And it puts us in better shape. When you reduce the time, it increases the amount of money. It's that simple. But the county has made the very conscious decision to make that trade-off. And I applaud the county for doing that. I think it's the right thing to do. But it hurts, you know. So it's fairly straightforward and simple in that issue. You know, when I have the amortization schedule from the actuary that shows we are projected to pay off the UAL in a 24-year time period. You know, we can argue over whether we should trust the actuaries or not, but we're moving in the right direction. That's the important thing to me. Yes, we have a $182 million unfunded liability, but the path is the right path. We're moving towards 100% funded over time.
Our underfunded liability is continuing to go up.
And that's why I put the amortization schedule in there, is to show
Our
that
actuary has never delivered to us. We've done pension obligation bonds to fix this, to make it fully funded, and we're always having to go back and have more debt. So we should have a discussion sometime, should we believe our actuary? That's a good discussion to have. I don't think this is the way to do it. But this, if anybody that looks at this from a financial perspective has seen the strength of this plan has continued to degrade. If this was a private plan today, it'd be critical. We'd have to stop paying, we'd have to reduce benefits. under the pension guarantee for a private employer, right? Should be critical. It would have been endangered, it's gone to critical. So and again, I understand what you're doing, I applaud it, I like your slides. My question is your language giving a false sense of security? This trustee obviously thinks you are.
I do not think it is giving our clients a false sense of security. I believe the benefits are secure. I believe the trust, it's, like I said, the situation is not rosy. There are issues that we have to work on and address, and I really look forward to getting to the point where we're not throwing rocks anymore. We're not just identifying problems. Let's work on solutions. That's what I look forward to, is let's work on solutions. But we are on the right path. I firmly believe that.
Mr. Knudsen.
I wouldn't want to put, we're absolutely maybe a little strong, but I wouldn't want to change it based on the feelings of one trustee. I know for years when we were, I forgot to ask the actuaries when they were at the meeting the other day, for many, many years, we said anything more than 18 years is negative amortization. And that was when we were at 8%. Have you talked to them what time period it is when we're at 7 1/4? It's got to be different than 18.
What, our amortization?
Okay, Mr. Stevens. Do you have an answer?
Well, if you look at the amortization schedule they just did, we only have 2 more years of negative amortization. And so that would put us at about 22, is what they're saying. If that's accurate, I don't know.
I don't
But
know
that's
how
what,
far it was before. but-
yeah, and then we also did the layering, put the layering
Yeah.
in place,
Pretty
so, which was a good move, I think a really good move, so.
Okay. Ms. Sheveringham,
Oh, I just have one other thing. If you do put something about the pension obligation bonds in here, about, like a footnote or however, if you want to do that, I think it is important that everybody knows that those will be paid off in 10 years. I mean, that $8 million, that's huge. I mean, that is huge, that in 10 years, that $8 million, it doesn't go out the door anymore for that. That can be going over here to this. In another 10 years with that, that's $80 million if you take that $8 million and you put it in this plan. Over that, that 10-year period's $80 million. I think that's something to make sure that everybody is aware of. It's not, that doesn't go forever. That, we have 10 years left on that. And not doing any more, right?
If I may, Mr. Chairman. The intent of these pension math slides is very much what I've shared with this board at the offsite, looking at a simplified cash flow analysis, and I'm very honest with them and say, this is not the reality of the situation, okay? If you project this out, things are changing all the time. But the bottom line is, where we are as of our last actuarial evaluation report, we had almost 40 years worth of benefits in the bank. The sky is not falling. That's the only point I'm trying to get across to the clients. I think if I include the pension obligation bonds, it muddies the water, so I will not be adding that
at all. Okay, I just think if you do,
presentation at all.
yeah, if you do, I think that there needs to be that notation that, that they're
For this
paid off.
target audience, I don't know if that would. And who have you given these presentations?
So I did this presentation for the human resources staff, and then the CEO asked me to also give the presentation to the department heads group. And the department heads gave me a lot of good feedback on the presentation that resulted in the very improved result you see before you now.
Scott?
Would it be possible to also just give this presentation to line staff?
Absolutely, and that was the intent.
Okay.
And the reason that the CEO wanted me to do this for the department heads was to make myself available to them, to come out at their pleasure and give a presentation to staff. If there's a staff meeting, I've made myself available to them. I need to send out a reminder. And then we're also talking about the possibility of doing this on a recurring basis as a potential training event for employees, where they could use work time to come attend a presentation. So we're looking at some different options of ways to get this information out in front of people.
Okay. You want to go into the administrative and operations update?
Yes, administrative and operations update. We have no, just continuing to work on implementing the pension administration system, and no significant issues around that. Or other major issues. I did want to advise the board that I did, it's not here, but I did want to advise you that I did file paperwork with Sackers to be considered for the treasurer position with the Sackers Board of Directors. We will see how that turns out, but I thought it, I felt like I could serve Sackers and the Retirement Association by doing that. I don't know, there will be an election, but just wanted to advise you of that.
About how much of your time would that take?
There are 4 meetings a year is what I'm told, and they are half-day meetings in Sacramento. That looks like about 4 days out of the year that would take.
And then would you be preparing your documents for that treasurer's meeting on site here?
Yes, yes.
So that'll take some more time.
Yeah, there is some work end of month for the treasurer's position, statements, closing books, that kind of stuff. But it's largely overview. So I would say all totaled, probably looking at no more than 40 to 60 hours for the year.
40 to 60 hours per year. Okay, 1 or 2 weeks. And did they reimburse you for your stay there and your travel, or do we pay for that?
My understanding is that the expectation is that MSERA would reimburse for those costs, if there are, travel costs.
So we'd pay for your stay and travel?
Mostly travel, probably not stay.
In those,
I'm not a stay overnight if I don't have to kind of guy.
are those independent of board meetings? So those are separate one-off meetings for the treasurer to meet in a board meeting?
No.
It's not our normal that we'd go to. It's not during that same time?
So Sackers has 2 conferences every year.
Mhm.
They have a board of, this is what I'm understanding, there are board of directors meetings that are concurrent with those. And then there are, I believe, 4 additional
Okay.
board of directors meetings in Sacramento that I would be expected to attend. So,
And this association actually has the same, administrator as my state association, Shaw, Yoder, and Antwi, I think.
You
And
share the same?
We share the same administrator, kind of, Sulema, I don't know if you know Sulema, that she's the
Yes,
administrator
I
for
do.
Sackers. Okay, so that group also takes care of our state association, and it is great, because like the treasurer and even like the secretary, things have changed a lot over the years. It used to be pretty time consuming when you did these, because you actually, if you were the secretary, you were taking the minutes. If you were the treasurer, you were doing the books, you were paying every bill, you were doing all that. That doesn't happen anymore. This company that takes care of it does most of that, and like James said, mostly it's oversight. It's just like so that another set of eyes looking at this, but they have their own auditor, they have their own accountant, they have their own setup there. So it's actually just having somebody in the mix, which is great. I mean, having somebody in, I feel, just going to my first Sackers in 3 years, in November, I see a real divided Sackers, and I think it would be nice to have somebody on our team.
Should have been there last May, if you want to see divided.
Yeah, I missed that one.
And not just somebody on our team, but someone to represent small counties.
Sure.
Right.
Because
Yeah.
the state just tends to roll over all of us.
Right.
Yeah.
I did think very carefully before submitting the information, and the idea was proposed to me the day of the deadline to submit the information. So there was not an opportunity to discuss it with the board. But I thought it was a great opportunity for this organization, because there's a lot of information to be gained and brought back here that might not be available otherwise.
So is it contested?
My understanding is there are more than two who submitted information. So I believe it may be 3 or 4, but I'm not sure.
So is Yeats up again, or does he have a longer term as president?
No, he's done as president, he's probably past president
He's gone.
now. He'll move into past president.
In July.
It's not required, but that is my understanding, is that he will move to past president.
All right, general board member discussion. Anybody have anything? Mr. Kingston?
Yeah, I don't want to go beyond the Brown Act and have specifics or anything, but we haven't discussed disabilities in months and months and months. I know we're using this outside agency, but are we receiving applications that we're forwarding on? Where do we stand on?
Currently, we have one application that we have received since the implementation with MMRO. We have submitted the information to them, and they are working on it now.
Only one?
Only one, yes, sir.
And we didn't send them any that we had received previous?
That is correct.
Where'd they all go? We used to get 10, 12 disabilities a year, or more.
I don't know. It's hard to know what's happening to things you can't see.
It's
I don't
very
know.
strange.
So all the ones we had are all finished? Or there's some,
I believe we are done with the prior process at this point. We had one that was outstanding, but it's been disposed of.
okay.
So.
Wow.
Mr. Sakowicz?
At the Callan event, I met with the founder and CEO of that organization, Ron Payton, and I mentioned to him something that I brought up at our joint board meeting, which was the advisability or possibility of allocating 5 or 10% towards a community wealth fund. An idea that you may remember was supported by Supervisors Hamburg and McCowan, at least in principle. And I'll be bringing an agenda item forward that we investigate that. But just for the record, Mr. Payton said he was excited that Callan would be tasked with looking into that.
Anybody else?
Question, 5 or 10% of our portfolio?
Well, it's, I mean, that would be a possibility. The state of Washington allocates about 5% to the Community Wealth Fund. In the state of New York, I think that's $400 million in the Community Wealth Fund. And this is an alternative to listed securities. It's an engine for local economic development, et cetera. But just to look at it in principle.
Anybody else have anything else? All right.
Very good. Public comment? Any more public comment?
Any more public comment? Nope. All right, this meeting is adjourned. Next meeting is Wednesday, March 16th, 2016 at 8:30 a.m. Thank you.
That would be scary.